Welcome to day 2 of the 2024 Virtual Think Tank event. A few weeks ago, the in-person event was held at the Momentum Investment offices in London with great success. With this virtual event, we are now able to expand the reach to more advisors in the UK, in South Africa, and all the other offshore markets where we have clients. Each year, we use this opportunity to share with you our latest investment thinking and insights, but also to showcase some of the specialist managers with whom we collaborate in our portfolios. Our aim at the think tank is to challenge established thinking, to help address today's complex global issues, but ultimately to deliver better results for our clients. Before I continue, just 2 housekeeping points around the virtual platform. The platform provides the ability to ask questions during the presentations. Members of the team, and in most cases the speakers themselves, will be on hand to chat and answer your questions. To earn CPD points, for SA viewers you must add your ID numbers, and for UK viewers please add your advisor firm FCA number. Back to the conference. Our Think Tank conference was first held in 2002, 22 years ago. A lot happened in this past 22 years. If you invested 10,000 in 2002, in the S&P 500, for example, this would have grown to 62,300, 6 times. And not too different if you invested this in the Momentum share price. But of course, if you invested this in Apple, it would have grown to 8.7 million, about 900 times, so choice is important. 22 years ago, only 50% of UK population had internet access in their homes. Today, almost every person in the UK will have internet access either at home or on mobile devices, and maybe not too dissimilar in South Africa. SpaceX, of course, grew from a startup in 2002 to a current valuation of around $200 billion and has revolutionized space technology and also set satellite-based broadband. A fantastic growth story. So when reflecting on this 22 years, it is true that with time comes growth. This is, of course, a very important investment and savings principle. So here we are today at the Virtual Think Tank 2024, 22 years on and still growing. And so too is it for our business. Momentum Group and Momentum Investments continue to grow and evolve within an environment that is also in transition. We have recently concluded our previous 3-year strategic cycle called Reinvent and Grow, and we have started a new 3-year cycle called the Impact Strategy. One of our Momentum Investments' key objectives in this new strategy is to establish ourselves as a truly global provider of investment solutions to you as our advisor partners and your clients. We have a great range of capabilities which can be depicted in this slide, our capability model, starting from the wealth and offshore platform to an annuities business and structured products, institutional platform, the multi-management solutions business on the left side, and the asset management capabilities on the right side. So as financial advisors and wealth managers, you should see the Momentum Wealth brand in the market, as well as our Equilibrium brand as the DFM provider and solutions enabler, but also Curate now as our retail asset management offering to you. Of course, the environment in which we operate also continues to evolve at a very fast pace. It is likely that we are well into a so-called fourth industrial revolution. The rate of digital change that it has introduced is phenomenal. 22 years ago, we would have hesitated to believe that AI would become a common word and that it has such an embedded influence on our daily lives. In this transformative era, digital and AI are at its core, redefining industries, challenging established paradigms, and creating unprecedented opportunities. This is not merely a continuation of technological advancements, but a profound shift that will, if it has not already, fundamentally change our way of life, work, and investment strategies. AI possesses the capability to generate significant new economic prospects and already has. Automation and efficiency gains will lead to increased productivity and economic growth. AI is already transforming trading algorithms, risk assessment, and customer service. And at Momentum Investments, we are also actively engaged with digital and AI-enabled solutions. And one example is in our investment business and processes, where we are starting to use AI in collaboration with M.M in some of our global fund strategies. And you will hear more from M.M a bit later today. Companies that invest in AI research and development, integrate AI into their operations, develop AI-driven products and services, and cultivate a skilled digital and AI workforce will find themselves at a competitive advantage. But with these advancements also come challenges: job displacement, privacy concerns, regulatory hurdles, and ethical considerations that must be addressed. Therefore, it is imperative that we embrace AI responsibly, balancing the excitement of the innovation but with a cautious approach to its risks. By ensuring that we maintain this balance, we can harness AI's potential to its fullest, but also safeguarding the values and principles that underpin our society. We must ensure that the human heart remains ingrained in our culture. Momentum Investments will continue to leverage digitalization for the benefits of our partners and clients, and to provide scale and capacity across our business. We will always adopt a curious mind to understand more, experiment more, and be brave in such things. But in concluding, it is important to stress that we are a people business first and foremost, and we see technology as an enabler for how we do business. Our people remain our differentiating asset. So what a great lineup of speakers we have for you today, and I have no doubt that you will be engaged, entertained, and informed. And lastly, thank you for choosing to invest your time with us at our Virtual Think Tank 2024.
Hi everyone, thanks very much for coming back post-lunch. So now we're going to hear from Evenlode, who managed our global equity portfolio, one of them. That's James Nodler, who is co-portfolio manager on the fund, and Christina Dyer, who is a dedicated analyst on strategy. It was their love of quality investing which attracted both of them to work for Evenlode. And if you're wondering why they both look so calm and fresh-faced, it's not just because they're picking quality companies which don't keep them up at night. It's also because they live and work in one of the most beautiful parts of the country, which is called the Cotswolds. So they don't have to deal with angry Londoners every morning on their way to work. So I'm going to pass you over to James.
Good afternoon, guys. I'll do the post-lunch slot. And thank you very much for having us in. Really appreciate it. As Jade mentioned, we work at Evenlode. I'll talk to you a little bit about who we are, what we do, and we will make reference to the theme of the day, which is artificial intelligence, and how what we do interacts with that. And I'll try and be crisp and leave time for questions. So I'll be very, very quick on all this stuff. And if I'm going too fast, please do ask questions afterwards. So who we are, we're, as Jade mentioned, based in the countryside. That's not actually our office. We have been around since 2009. A little bit about us, we manage about $7.5 billion in 3 strategies. We are very much long-only concentrated portfolios, and I'll talk a little bit about our philosophy and our process later on. And the thing really we'll get to later is our ownership structure as well, which is, I think unique for a boutique. I've been on board since 2020, and as mentioned, I co-manage the global equity strategy, which Christina works on as well. And very briefly, what we do, we have a definition of what we count as quality. We'll get into that in a moment. We look for companies which can compound over time, and we look to manage risks. Well, today is all about risk, upside and downside, and we look to manage valuation risk, very importantly. We believe that investment outcomes are price sensitive. And this is the nub of it, really. And the point is, when we define quality, I was just talking to Gary here about the academic research on this. People like Eugene Farmer, the factor research that people like Farmer and Asness have done. Our definition is very qualitative. We say it's a high return on invested capital, but more importantly, it's your ability to keep that return on invested capital high for a long time. This is what's called a Sankey diagram, and it shows you that your starting ROIC is not particularly differentiating for your performance. The 2 buckets, and this is a persistent finding over time, high ROIC and low ROIC, if you took the whole bucket at the outset, they have very similar returns. what differentiates them is your ability to keep it high over time. And the signals for your ability to keep it high over time are, in our experience, primarily qualitative, and that's where we spend our time. And what we're going to do now, just to level set what we're trying to achieve, is talk to you about three different ways, three different types of risk we look at, and with specific reference to artificial intelligence. Just to level set at the start, when we think about artificial intelligence, our guiding assumption at this moment, and we're very data driven on it, is that it is not fundamentally going to revolutionize the world we live in. It is another extremely powerful, extremely dynamic technology, but there have been similar bouts of innovation going back to the Industrial Revolution, the appearance of computing technology, of the internet. This is an intensification and amplification of these, the ability to apply computing to problems. So we're going to think it's going to make some things radically cheaper, faster, more efficient, but we don't think it's going to fundamentally revolutionize industry dynamics. So if you're in an industry which has historically struggled to price through and capture excess returns on capital, it's going to be probably table stakes. So to give you an example, there's a lot of application already to consumer service, to customer service. And the idea is we're going to radically slim down our customer service centers and replace them with chatbots. Our expectation is this will take place over several years, but the benefits are likely to be competed away. We can't see how structurally this has changed those industries which are very dependent on customer service to enable them to capture those excess returns, thinking about, let's say, airlines, telecoms, etc. Likewise, it will probably improve credit scoring radically, so you can underwrite better, in particularly in consumer, where you've got bigger masses of data to work with. But historically, it's been very difficult if you're in financial services to capture the upside from better underwriting. It tends to be competed away. So that's sort of the throat clearing part. We'll talk about how we, going from the base of the business, the fundamental structure, which is the people and the way we're owned, the way we manage risk there, then into the process, and then into the way we assemble our portfolios. So just to start off with on business, the things really to get across here is that, look, artificial intelligence is really powerful where you've got lots of compute, lots of data. At the level of how you structure your firm, we think the same principles apply today that would have applied in the days of the rotary telephone and the slide rule. What's really important is that you get the right people, you incentivize them the right way, and you create it as a long-term partnership which is clearly aligned with your clients. That held true 100 years ago, 200 years ago. We think it will hold true in 100 years' time. So having a perpetual mission, I think it is a perpetual mission. We don't know when our clients will want us to stop managing their money. We assume it's, as long as, we have to assume it's practically indefinite. And a necessity of reinvesting in. One of the key areas you reinvest in is people. So one thing we've done, which we really want to stress, is that we are owned by a trust, and the trust's beneficiaries are the current employees, all the people on that screen. This is similar to a big UK retailer, John Lewis, which you may or may not know. And what this does is it means we are less, we're not open for sale, because a majority of the employees would have to vote for it, and we'd have to break the trust to be very onerous. And we're incentivized to keep on investing in people and systems. The other point is that in any partnership, it really helps to have a diversity of thought and a diversity of experience. And again, we don't think anything about innovation has changed that. That was the case 100 years ago. It will be the case in 100 years. We are technologically enabled. We have our own proprietary research management system. So we have 5 full-time technologists, coders in our team. With that being said, at the level of an AI enablement at this point is relatively low. We are not dealing with giant volumes of data here. It's a qualitative world we live in. Data are scarce, and that's part of the value we provide. What we do have is a good base that we can apply it to over time. And final point is really, because we were started in 2009, we had a pretty clean sheet of paper to work with, so we could start by saying we want the right ownership structure, we want the right technological enablement for sharing data, making it available for all decision making. And we also want to have a structure which is designed from a clean sheet of paper. So it's very clear how we're set up. The first decision we make when we're building our universe and our portfolios is on quality. And we'll get into that in a second. That is completely upstream and discrete to the decisions around risk management, which are based on idiosyncratic business level risk, which cannot be diversified away, and then valuation. So it's set up in a compartmentalized fashion so that we don't have. So one issue, I've always had with building quality value hybrid portfolios is what is driving the truck. And we want it to be really clear that quality is the overwhelming gating criteria. Everything else is downstream from that. And having that laid out that way is super important to us. So that's the first leg, and maybe a little bit now about the process, if that's an appropriate moment.
So we are bottom-up fundamental investors, and we want to invest in companies with strong fundamentals. What that means for us is finding companies that meet the 6 criteria around this slide. So from a numbers point of view, it's not going to come as a surprise that we want companies that are profitable, they're not highly in debt, and we have an additional asset light requirement. This side of the wheel is fairly straightforward. It can be easily automated. Anyone here can get their phone out and ask ChatGPT to give a list of 50 companies that meet this criteria. The question for us is, once we identify companies that have these historic metrics, how do we make sure that they stay in that top green bar that James showed, and they don't take the red escalator down to produce low returns for shareholders? And that's where qualitative analysis comes in, and this is where we spend most of our time. The really important bucket for us on the qualitative side is the durable competitive advantage. So what is it about the company that we invest in that makes it unique so that it over-indexes in the market growth? And of course, the competitive advantage is only as good as you can sustain it. We're looking for evidence that the company is sacrificing profit margins in the short term to generate those incremental returns into the future. And like James said, our fundamental bet is that generative AI is not going to alter industry dynamics. If I make a barrel of oil and James makes a barrel of oil, and then one of us starts using AI to get a cost benefit in our production process, the other one is going to soon adopt it. So any cost benefit that we get is going to be competed away over time. Where we think generative AI is going to be a benefit is in companies that already have an established, strong, sustainable advantage. So, for example, companies with very strong proprietary data sets. And 2 names that we have in the portfolio are RELX and Wolters Kluwer. They're both data service providers. They provide data and information for professionals, so doctors, accountants, lawyers. Every time they want to make a decision, they will need to use their data set into their workflow. And really is a pain in the neck if you try to switch out of these providers. So it's not worth the hassle. Gen AI for them is an addition, is not a replacement of the product set. If a competitor simply has a language interface and is not powered by the actual asset that provides the value, it's not going to make a difference for their clients. And from our channel checks, talking to management and the clients, it seems that it's going to take a long time for things to change, for workflows to adapt to the new technology. However, fundamentals change, and they do change. So the way we monitor changing fundamentals over time is through this checklist of 9 risk factors. This is presented as a radar chart. It looks a bit like a 50p coin, except it has 9 corners, not 7. I couldn't think of a coin with 9 corners. But what we're trying to do with this is to spell out how the fundamentals can change for the worse or for the better. And we scored this on an alphabetical scale. It goes from A, which is the highest score, to E, the lowest score. We're not trying to be overly precise. That's also a risk. But it's a qualitative judgment, and we're not trying to force it to be a quantitative judgment. And if you think of a company, let's say L'Oreal, French consumer giant, and how you would score it around this chart, in our assessment, we think L'Oreal scores very well. It's almost a perfect score. There's a little bit missing in the shape. And overall, we give L'Oreal a 7.5 maximum position sizing. So that means that if the valuation of L'Oreal is very compelling, we would own a maximum of 7.5%, and we wouldn't go above this. We use this checklist to monitor the quality of every single company that comes into our investable universe, and also, as an example, L'Oreal, to decide on the position sizing. Contrasting L'Oreal with one of the companies that was highly debated around generative AI, so Alphabet, the parent company of Google. We also score Alphabet very well on this metric, but the shape is a bit more narrower. It's more of an oval than a big circle. And that's just to account for the exposure to advertisement revenues and a bit of cyclicality there. Almost for 2 years, we've been doing a lot of work on understanding if the competitive advantage of Google is going to be eroded away by generative AI. And we've done a lot of talks with industry experts, looked at data sets, looked at the data that came out of the Department of Justice antitrust trial against L'Oreal, against Google. And what we found is that the fundamental click and query data of Google, it's not being altered by generative AI. That treasure trove of data that they have, it's still going to power them to have the next iteration of the algorithm that is going to allow them to take advantage of the generative AI trend. So whilst our research has uncovered a changing potential tail risk that has increased, we have adjusted one of this risk scores to reflect that. So the long-term industry outlook, we've adjusted it from being an A to being a B. So just incrementally reflecting that increased probability of the tail risk of Google. We still have a large position in Google, and that's because at the time when we did this research, the company looked very compelling from a valuation point of view, and we had a lot of headroom to our max position. So since the beginning of 2023, we've increased our position in Google. So we are quality first, but valuation second investors. And I'm going to hand back to James.
Christine. All right, guys, this is the home stretch. The valuation, and I think I said earlier that the contention is that your investment outcomes are valuation sensitive. This is like a nonce example. If you looked at lots of other situations, Nifty 50 in the early 70s, there's like loads, right? You can get lots of situations where the fundamentals stay pretty good. And this is not just a tech example. Walmart traded up tons because space growth was crazy in the 90s, right? They're growing like for like, so growing space. There was a huge TAM, right? It's a chart we've seen lots of times, and what we've done is tried to cut off the chart around where they took out their previous nominal high. Clearly, if you assume a cost of equity capital is like 6% per annum, just whatever, somewhere in that range, you have to run that chart forward quite a long way forward, even at parameters, until you have achieved a 6% compounding from the entry position if you manage to buy at highs. And you can do the same. Someone's done some pretty interesting work on the US equity market. It's replicated by the world. You can have situations where you buy for 10 years, you have pretty poor returns if you go all in on 1 year. And there's work by Edward Macquarie which looks back 180 years. I won't belabor the point. The idea behind it is that you have to be thoughtful about price when you go in. And we've always been run this way. It's 15 years now, and it falls back on a longer body of data. Now, there's some other slides in the chart. I don't want to go into onerous detail. The point we want to make is that we don't use like a price earnings ratio or a free cash flow yield per se. There are issues of those. Christina touched on how we think about those three dark blue slices of the pie: your reinvestment, your competitive advantage, and your underlying market growth. you need to incorporate thoughts about them into your valuation. And what we do is, in essence, I won't bore you with the hijinks, it's a reverse DCF. And what we're looking at, so what we do is we work out what a company's compounding should be over time, incorporating thoughts about reinvestment and underlying market growth. Essentially, the reinvestment gives you information on the durability of the competitive advantage. And you try to be economical and elegant with your assumptions. You don't want to be building in really complicated models. It should be simple. And what you get from that, a set of signals. Actually, I'll show you an example where you're saying time to push, time to pull back. So Hermes is traditionally a very expensive stock. It's traded at big premium to the CAC 40, to the SXXP, to the world for a very long time, even to its peers in luxury. And we had signals to push in a bit more, and you can see how our position sizing has come and gone. We built a very large position in mid-2022 when it was about €1,000. The point is that we had to have a valuation system which rewarded them for some of their actions, right? And what they've done over time, they have deliberately restricted the supply of their stock to the market by quite a remarkable degree. They've shown enormous restraint, and that's a key area of reinvestment. Also, importantly, it's very hard to analyze it quantitatively. It doesn't show up in your P&L, the fact that you're holding back so much stock. You have to analyze other data sources. For example, the fact that alone amongst large handbag manufacturers, their handbags tend to trade in the second-hand market at a large premium to the first-hand market. You have to look at the fact that their gross margins are quite similar to their peer LVMH fashion leather goods, despite being much higher spec and much higher price. They're putting a lot more into the bag, and they're being more restrained about what they're asking for the bag in the primary market. So these are quite subtle signals. They're also, they're not growing their space. They haven't added to their store count really in the last decade, whereas large peers, even the highest quality, are growing stores by about 4% per annum. And that's an index for the volume growth and the increasing ubiquity of these products. So these are signals that you want to incorporate into your valuation. You can be valuation aware even when you're investing in companies with high price earnings ratios. These are also signals that push you out of companies with low price earnings ratios, but where they are selling the farm to make numbers. And they're mining earnings in 5 years' time, 10 years' time, 15 years' time for the benefit of today. So we can go into this another time, but the point is that you need to be conscious of these different signals, and they apply for every company, for every industry. They're very, very important right now. We're very mindful of them, and yeah, I think I just want to wrap up by saying what we've gone through. Hopefully, got a sense of how we are conscious of the attractions of equities over the long term. There's a big body of evidence that if you can get in equities and stay disciplined and committed to them, you and your clients will have a very good outcome. That being said, there are risks. You need to be conscious of, in our line of work, getting the wrong company, being wrong with your value assessment, and two, getting the right company at a wrong price. These are two things that we think about intensely, and underneath them, we have a discipline about the way we manage our company, the way we hire our people, the way we invest in research and technology, and that's all about creating that alignment. And we think if you select the things you're managing to and keep them simple, stick to them, tell people about them, revisit your assumptions as well, to the point about, we are conscious of keeping an eye on what's going on with AI. Hermes is not particularly AI relevant, but there are lots of companies we look at which are highly AI relevant. It's to keep those channel checks, look at data which are often scarce, hard to access, hard to digitize. There's a lot in there for an active manager, but precisely because they're so hard to systematize. And if we have that sense, we've always had that sense since our foundation of that's being our discipline, we are optimistic about the world that's ahead of us. Probably want to wrap up there. If people have questions, please do ask us or grab us afterwards. And thank you very much on behalf of everyone at Evenload for your time and your interest.
would you mind just going back one slide?
Yeah. That one.
We have the 4 examples. Sorry, that's...
Yeah.
There we go. 2 questions. The first one is, did you include the effect of dividend on the share price in these graphs? And then secondly, which ones of these do you hold or not, and for what reason?
Sure. Yeah. No, but this is nominal. Couple of them haven't paid a dividend in that period. But yeah, you're right. TSR will be slightly different to nominal return. But even, mutatis mutandis, you're still going to be underwater for a hell of a long time, right? But no, you're right.
Because when Microsoft paid somewhere with their dividend yield probably ranged between 1 and 2.5% over that period. Amazon hasn't paid a dividend.
Yeah.
Walmart is about, I think, 1%, so probably not material. I don't know about Cisco.
Yeah. No, take your point. We can show TSR as well, but I think the holding remains robust. That, you can be waiting a very long time, 8, 9, 10, 20 years, for a business to grow into an excessive valuation. You're absolutely correct that, this was done on the sideline from my day job. But you're absolutely right. I think and it depends on horizon, but particularly when you take that 6% cost of capital, you're asking a lot of anyone, even Warren Buffett, to sit and wait. But you're absolutely right. And then of those 2, we actually hold Microsoft and Amazon. And Amazon we bought in 22. Microsoft we've held from inception. We are very conscious that their free cash flows are going down, particularly Microsoft's. Now, our valuation model, so I should have said, there's this problem with free cash flow because you're taking out discretionary key free cash flow, so naughty for doing that, but it's fine if you then spend it on M&A. You want to level set it and get to what Buffett calls owner earnings, right? So it's capital structure neutral after ESOP, but before discretionary. So we reward people for discretionary cash flow, CapEx, but there's a ton of it going on right now, so that is an elevated risk. Going back to the radar chart, cash generation is on downward watch for sure. Sorry if that was too full, but thank you very much for the questions.
Hi, how do you determine the number of quality firms that you would include? And is that done on the basis of a particular threshold of your assessment of that quality, or do you target a particular number of organisations when you're constructing?
Yeah, that's a great question. Our finding is that typically there's just not that many companies which fit in to our definition. I think we track about a couple hundred across our strategies. We have our 2, I should have said, our genealogy is historically in income. So we have quite a lot of companies where the income is attractive enough that we can, when we're optimizing for 4 things, because we've got that chart, there's 3 things we optimize for, where with income there's a 4th. But basically for this strategy, there are fewer than 200. We would like to be relatively diversified. We typically look to have about 30 holdings. There is not a science to how we determine exactly how many, but there's a rule of thumb, which is, your 31st idea or your 32nd idea, right? There's a diminishing marginal outcomes. Position sizing, hopefully this is sort of getting to it. Position sizing is very much driven by those idiosyncratic risk pieces and then by valuation. I mean, you could run this with 10 stocks, but then you'd be asking your clients to stomach much more vol. You could, I think when you get upwards of 40 to 50 stocks, you're really, I think I would feel myself turning very beige, There's a right level of differentiation. We're 90% active share, right? So you will have a high active share. You don't want your clients to stomach too much vol. And do you see what I mean? Like 30 feels right, and we think we've got a nice diversification by category, by end market, etc.
Thank you. From an earlier slide, you can see that your team has a very diverse backgrounds: immunology, theology.
Yeah.
So, what are the risks that you're seeing that keeps you up at night, or?
Yeah.
Yeah.
Risks that keep us up at night. Yeah. Sometimes I have 3 children under 3, so there's not like a ton of sleep at the moment, but it's not the portfolio per se. Yeah, I mean, look, going back to AI, I think probably just say there is an upside risk to AI, which is AGI, But I think preparing the portfolio for that is like preparing the portfolio for nuclear war. Like, if it happens, all bets are off. We have infinite, abundant processing power and innovation. I think we're in a very different economy, and I don't think people are going to be that bothered about their 401ks or their ISAs, right? But stepping back more realistically, concerns that keep us up at night, there's lots. I'd say one worry is like definitely we're in a situation which always worries us a bit, where earnings estimates are doing one thing and cash flow estimates are doing another for a lot of companies, right? And if you're a cash flow centric investor, accrual earnings running ahead of cash flow earnings is gives you the heebie-jeebies. Limits to innovation in categories is always a worry. And I think there is a lot of people are rehearsing that worry right now about consumer staples in particular. Staples are probably slightly less worried about, again, based on the work and the channel checks, but you have to be respectful of that. I think history shows that a lot of categories are great and then they hit a limit to their innovation opportunity, and then it's like a bug hitting a screen door. So that's something you got to. So that's going back to like what creates risk. The primary one is the assessment of the business's quality is wrong, and that's the real permanent loss of capital thing. And then valuation to a lesser extent. That screen I showed you, that's like outsized valuation risk. That was like a proper 3 standard deviation or whatever event in 2000. I don't know how many standard deviations, Gary will know better than me, but that it can cause loss of capital as well. So hopefully that there's lots of company by company. Definitely overbuild of compute is something I'm conscious of, and we are exposed to it. Everyone is in the market pretty much right now. And then, limits to innovation, fatigue by the consumer, that sort of thing.
Any more questions?
Thank you.
So my name's Richard Perfect. I'm one of the managers, and I run the newly launched Real Assets Growth and Income Fund, which you'll be hearing more about tomorrow. But today, just wanted to introduce to you a couple of very interesting investment opportunities that we have within our portfolios, which is focused on private equity. So the scale of the private equity market by number of companies essentially dwarfs public listed markets. And it's fair to say that the exits from private equity houses often don't even go anywhere near the public markets. They're sold as trade sales to other private companies. And the companies that do make it to the listed markets today were probably founded 10, 11 years ago. And some of the best IRRs, some of the best returns have already been experienced through that period before the public markets see it. So it's crazy to miss out on some of those best opportunities. But that doesn't come without risk. Due diligence is required, and quite often a fair degree of hand-holding is required by the PE houses that nurture those early stage companies. And so it's with that in mind that I'm very, very pleased to welcome Ben Wilkinson, CFO of Molten Ventures, which is a PE VC house, has £1.3 billion of assets on its balance sheet, and it's held across various portfolios that we're running. And Ben's going to talk about this vital area of investment, and he's also joined by Mike Walters, the CEO of Form 3, which is one of the portfolio companies within Molten Ventures. So thank you, Ben.
Thank you, Richard, and thank you for inviting us along to speak to you about our company. The thematic that you've been hearing a lot about today, and I'm conscious we're coming towards the end of the day, but is about how you can get access to growth, how you can get access to innovation, and particularly AI. And just so happens that that's what we focus on. So that's the topic we're going to talk to you about today. I thought I would start first with a little bit about Molten Ventures, As Richard said, we're listed here on the London Stock Exchange. We're constituent of the FTSE 250. We talk here about how much capital we've deployed since our IPO. We have two IPOs in fact, the first one being in 2016 when we moved on to the junior market, and then in 2021 when we graduated up to the main market. And since that time in 2016, we've invested over £1 billion into underlying portfolio companies. The companies that we look to invest in are companies that are born in Europe. So Europe is our geographical spread. In the venture capital market that we operate within, the UK is about 40% of that European market. So just to give you a bit of context, the majority of what we do will be still within the UK, but we have a broad reach across wider Europe. And we're really looking at companies that are not at the earliest stage of their journey. So we like to see some proof points of commercial traction, but we're looking at companies that have interesting technology, that are in fast growing and significant size of markets, that can be global leaders in the space that they operate within, and that they have a point of differentiation and an inherent underlying IP. So the technology that underpins the companies is the important aspect. In terms of these headline stats, we've invested the billion, but we've also received back onto our balance sheet. We're structured as an evergreen balance sheet, so capital that we recycle from realizations comes back to be redeployed, and we've had £600 million coming back since that 2016 period. And I'll talk to you in a bit more detail about that importance of obviously turning our fair value of our portfolio into cash and the proof points that gives us, as well as the additional liquidity that gives us. And then some stats from our last reporting period, which was as of March, our year end. We have 1.4 billion of gross portfolio value. That then translates down into a net asset value of just over 1.2 billion. And I will talk a little more around the broader model, but we do manage assets alongside the balance sheet as well. And the benefit of that is that it gives us some income coming into the balance sheet. So when we talk about costs, the costs are being offset by the income structure. And a broad portfolio right now of 110 companies, like most portfolios, skewed to the top 20 names where the majority of the value sits, and we'll come into that as well. So for those that are less familiar with venture capital, I've actually just pulled a few of the slides from the British Business Bank's report, and the British Business Bank puts out these reports, quite a broad cohort that they're looking at here, 2002 to 2018 in terms of the vintage year. But what I wanted to draw your attention to, and I might just come across here and point, is you have these bars for TVPI. TVPI is total value paid in, which is effectively the full value of the fund, including what it's distributed out, but also what it has remaining in the fund value. And this is for UK venture capital. And you can see the spread here of just over 1x to 2.5x. So this is often done on multiple of invested capital. So you're looking at how much capital has been paid in, and therefore what's the fund valued at that point in time. And you can see that range of distributions here, but you can also see, reflecting across to the US, that you'll have a broader range of distributions with some more at the top end. But actually, if you look at the medians, it's pretty similar. So the medians for venture capital are around a 2x multiple on your invested capital. You have to align that with this second chart, which is looking at distributions, and this is distributions of returns across managers. You have a blue line for UK, a green line for US, and a dotted line for the rest of Europe. And actually, the important part of venture capital, when you look at this, is quite how steep that curve is between your upper decile, upper quartile, and your median. When you invest in venture, it's very important to be in managers that are achieving this side of the line. And that's why venture is considered a risky asset class, because you can have a spread of distributions, but also if you're in managers that don't necessarily have the track record, you can be in scenarios where you don't get your capital back. And so what's very important about venture capital is obviously the managers that you trust with your capital and how they invest that through vintages. The time in the market is equally as important as picking your point of entry into the market. And so when I talk to you about our structure and how we mitigate risk and manage risk in our portfolio, it's worth bearing in mind VC as an asset class in its own right. So then moving you through to what does the European market look like? So first chart, we're able to give you a sense of VC versus US VC, because I think there's still a misconception that European VC will be the poor cousin. You can see the returns are actually quite similar. particularly as Europe has been maturing as a market over the last 10 years. And on the chart on the left-hand side, this is capital raised by deal size. So it's just how much capital is deployed in the market. And very similar to the US, you'll see peak period here in 2021. And in 2022, this was clearly the top of the market. But as you can see before that, and ignoring those two bars, you've actually got a trajectory of growth around 30% a year in the market ever since that 2015 period. And so what we're seeing is a maturing of this market such that at the 2019 into 2020 period, it's over 60 million, having started at around 20 billion in size when we IPO'd this vehicle. This is only one quarter, so you can ignore that stat. But looking back to last year, it's starting to get back to those sorts of levels pre that peak trend. To put that into context, what you'll find is that is up still about a third the size of the US market. So in terms of where this market can grow to, and if you look at stats of capital deployed into venture as a proportion of GDP, but if you also look at the rate of IP that's created in Europe, it's equivalent to the US in terms of the IP, but we're investing a lot less per capita than in the US. So the gap that we have now can still close substantially further. And then this is mirrored in a similar way with deal count across the region. The important thing to look at on deal count is the blue bars here are the very early stage. These are investment checks of 0 to 2 million, so we'd call that seed stage investment. You'll see quite a lot of capital goes into the number of deals, rather. There's quite a large number of deals, but if you look on the left-hand side, it's a very small proportion of the actual capital. And the majority of the capital tends to come into very few deals at those later stages. And I'll talk to you a little bit about the life cycle of a company and how that mirrors into this as well. So coming back to the theme of the conference, technology has driven productivity, continues to drive innovation in economies. And if we see on the very left-hand side of this chart, first industrial revolution, not much changing as a proportion of GDP. And then this obviously is steepening in the last 100 years. And the line is accelerating. If you could kind of zoom into this part of the line here, the third industrial revolution, where we were looking at automation, handheld devices, silicon chips, really driving a lot of that from Silicon Valley in the 1950s, 1960s. That's changed the way that we've been able to use mobile phone devices, launch rockets, the handheld computers that come with it. And that's now led into the compute power that's driving this next fourth industrial revolution. And I think it's the companies that we're investing into today, and this is why venture is very important to invest across vintages, because it's those companies that break out, and it might take them 10, 15 years before they're breaking out, but they'll be the ones that win significant market share. And I'll show you that venture is very much an asset class that's skewed to the winners. So you can manage your portfolio of assets. So if you invest in 100 deals, you can manage your portfolio of assets, but it's probably the top 20, 30% that are going to drive the majority of your returns. And therefore, you're in a business where you have to build portfolios and you have to be consistent about building them and getting access to different technologies. So how does that play into our existing portfolio and some of the themes around this industrial revolution? Number 4.0. So we're going to touch on fintech in a bit more detail later on, but just to give you a sense of some of the names, obviously companies like Revolut are now, particularly in Europe, household names. They have over 40 million users, last raised capital at an implied valuation of 45 billion. When we invested in Revolut, we invested in their Series C round when they were valued less than $1 billion. That gives you a sense of where we're getting into the journeys on these companies. At the time when we invested, Revolut was still gross margin negative. So we're often investing in loss-making companies. Usually, the majority of what we invest in has an average gross margin of 70%. This was an exception because we could see that the market was shifting so quickly and that their ability to innovate products was so strong that we wanted to be part of that journey. And we invested about £8 million, just to give you a sense, which is now currently valued at the last round value about 160 million. So that's an example of where it can go right. You get multiple times your investment capital. Other companies, Form 3, we're going to introduce you to and talk in more detail. and then companies like Thought Machine, which is core banking systems, and Free Trade, which is allowing consumers to trade public stocks through their apps. Other themes, climate has been a big thematic over the last couple of years. We've invested in companies that are looking to create carbon markets and companies that are looking at scope 1, 2, 3 emissions for large corporates like Heinz, so looking at their whole supply chain and giving them the data behind that, how they can then report on their ESG. In the space arena, we've got low Earth orbit satellites like ISI, which take images of the Earth, and they can use that imaging for data products into, for example, insurance. So if you have a flood or you have a fire, they can take images of what's occurred, and then they can use that for the payouts, and that's creating an efficiency on those industries. In the healthcare space, we don't invest where there's clinical trials. What we're investing in is where the intersection of data and health come together. So we're interested in businesses like Endomagnetics, which was a breast cancer surgery device, Clue, which is a female health app, which has about 12 million global users, and then companies like AISO, which is looking at mental health services online. And mental health has a significant unmet need through the clinical practices, and if moving it online, in particular with cognitive behavioral therapy, allows you to meet a larger swathe of the population and to triage a larger swathe of the population. So these are areas where digital and technology can accelerate and even increase the size of markets by giving you access to a greater number of users. And on the AI and meta side, we've had a company, GraphCore, which we've actually exited this year. That was a silicon chip company based out of Bristol. It actually designed an intelligent processing unit, which was a chip specifically for machine learning, artificial intelligence. And when that company was formed, it was around the sort of 2017 period. Its main competitor was NVIDIA, and you could argue that NVIDIA won that battle, but that gives you a sense of the market opportunity. One company that I'll mention on this deep tech arena is Riverlane, based in Cambridge. That's a quantum computing software. So this is a software layer that sits across all of the quantum hardware. And over the next 2-3 years, we're going to hear a lot more about quantum computing, the power of that compute, and how that's changing cryptography, and how that's changing the ability to have nuclear fusion, for example. So you can think about all of these areas as connected, and the reason why we invest as a generalist across all of these is because they all link to other parts of the value chain. This slide is touching a little on our business model, and we tried to encapsulate a few things on this slide, so bear with me for a moment. But on the left-hand side, we'll have our investment process. I showed you a slide where we looked at the number of deals done in Europe, and there's about 7,000 to 8,000 deals a year done in the venture capital space. So we're screening thousands of companies. The stage that we invest at is important because at the seed stage, we've become a limited partner, which is an investor into seed funds. And we now have a program with about 80 seed funds across Europe, which are the first ticket into exciting technology companies. And they'll be across the Nordics, across the German-speaking part of the market, also into the UK and then into Southern Europe. So it's parts of the ecosystem where we don't have offices and people on the ground, but the technology is interesting. And at the seed stage, they'll be investing 500,000, 1 million, maybe 2 million into those companies. But the breadth of their portfolio will be much wider. So they'll be investing in 50 up to 100 companies, of which the winners in that portfolio will maybe the top 10%. And it's the top 10% that will then graduate to the next stage. So where we start to put our own capital to work from the balance sheet, but also I've got 2 boxes here for EIS and VCT funds, which are co-investment managed funds. We put that to work at what we're calling the early stage, which is effectively a Series A. So it's where a company has commercial traction, maybe 2+ million of revenue. They've got a team in place, they've got a product that's working, and then they're selling that. And that's the stage where we start to get involved. An important part of how we invest is not just the capital, but we invest our time. We sit on the boards of those companies, and that gives us the ability to help those founders to achieve their goals, to accelerate the businesses, to avoid some of the mistakes we've seen previously also, and to give us certain veto rights and controls within the company. So even though we'll be a minority investor and our average equity stakes will be around 11%, we'll still have significant control by our board positions. And also the fact that the risk around venture capital, the management of that risk, it's a syndicated model. So there'll be us as a venture capital firm, but you usually have 2 or 3 other venture capital firms around the cap table or the board table in this case. And that allows that risk to be syndicated. So in this model, I used to work in the oil business, and this is very similar to how you will think about geological risk of an oil well and sharing that risk between different parties. As we move into the growth stage, this is where we consider it to be a Series B investment. The company's then started to scale. It's got more customers. It's been upselling into those customers. And it's at the stage where it's ready to enter new markets. And that's when you'll put significantly more capital to work and you will increase your equity in that business for the next stage of that journey. Quite often with venture, it's like a relay race and you're passing the baton to the next lead investor. And what I mean by that is the next investor at each stage will often be the majority ticket for that round. So in a Series B example, if the company's raising 30 million, the lead investor will probably be putting 40 to 50% of the round together. They will then take a seat on the board alongside the earlier stage investors. And that's also a method of how the capital is managed and triaged through the journey. Because we have an evergreen balance sheet, we're able to look at our portfolio over periods of time and think about that capital allocation quite differently to some of our competitors who will live in a fund world. So they'll raise a fund. A fund will have a 10-year life, and so they've got to invest that capital and then harvest that capital within a defined period of time. We have the benefit of being able to stay with our companies for longer. If they continue to grow, if they continue to show that there's significant market share still available, we can put more capital to work in those businesses. And I think that gives us an advantage over some of our competitors. As that company life cycle continues, the growth continues, they move into the later stage. The exit point of our journey, 80% of the time the exit is pre an IPO. So they'll quite often be sold into large corporates, or it might be a private equity roll-up in a minority of situations. The majority of time what we're seeing is an outsourced R&D model where large, particularly US corporates will be wanting to buy the technologies coming in, and that's the majority of our returns and our realizations. And as I say, we've had over 600 million now to date, with over 100 of that done just this year from exits in our portfolio. This is a sense of the portfolio and how we put that into different categories. We keep quite broad categories, and within these 4 pillars of consumer technology, we're selling to consumers, enterprise technology, selling to corporates, and then hardware and deep tech, and then finally the 4th being digital health and wellness. You've got a lot of sub-thematics of technology like climate, like fintech that I mentioned, and so within this there's quite a lot of crossover, but you can see the majority of what we invest in is selling into corporates. It's large recurring revenue models that we're usually investing into. This slide is giving you just a bit more of a sense of that seed program. There's a bunch of logos really, but it gives you a sense of the breadth of the geography that we're covering with that, and we think that that's quite unique in the venture capital ecosystem, in that we have 2,000 underlying companies that we're monitoring and have the data on every quarter. So it gives us a jump on the next investments that we want to make by mapping this. And actually the returns are good. The managers we invest in have 2x to 3x track records, but it's the data that we're more interested in reality. So I said at the outset that we have this 110 company broad portfolio, but it's the top 20 that you really need to consider. This is the slide that we present every 6 months to the public markets, and it shows our largest assets. And if we look at how we present this information, we'll have the opening balance sheet fair value position, any investments we made in the period, then looking at the fair value movements, which are in the green, and then we'll have fair value decreases, which are in the red. And it's important to point out that the valuation of the portfolio through the journey is an important part of our communication tool with our investors, but also an important part of the journey to show our investors that we're being prudent in that approach. And so we'll make adjustments to these based on the commercial traction of those companies. And we talked about exits being the ultimate litmus test. when people are monitoring over several periods of time, which Richard has done with ourselves, he will see how we mark the portfolio and then ultimately where we sell the assets. And that gives that confidence of our approach. And we're always selling our assets above where we've been holding them in the books. And that's something that we'll continue to achieve by being sensible about writing the companies down if not making traction, but also being very slow to write them up. The growth in the portfolio is underpinned ultimately by the growth in the revenue and the commercial traction of those businesses. And if we just look at two of the other charts, which we demonstrate, on the left-hand side, we have our P&L returns. And you can see over the financial years, that's mostly been positive, but we've had negative returns in that period where the market has corrected. And we were very quick to take down the value of our portfolio in line with the public markets to ensure that the multiples that were being demonstrated for technology companies were quickly reflected through. And I think that's clearly important, but also it's an important component of the confidence that we can give to the market by making sure that we're valuing these prudently. And there's a couple of dotted lines there. The first in the yellow is our target returns. We call it through the cycle, but our target returns are 20% on the portfolio. So we are able to deliver that through that commercial traction of the companies, their revenues growing, if multiples are staying equal, obviously, but also through them raising additional capital. And when the companies raise additional capital, if there's third-party capital coming in a market price discovery process, that's when we've got the ability under the valuation guidelines to move those companies up. What we will often do as a house is take that round value, but take a discount to that and then move them up a little bit more slowly once we see the commercial traction coming through. We think that gives us a buffer of being a little bit more prudent. On the right-hand side, I've touched on cash realizations. This is the number 525 as of the end of March. We've delivered over 100 million in this financial year, but our target is 10% of the opening portfolio value. So in the case of having an opening portfolio value of 1.3 billion, we're broadly targeting 130 million for the year. And this year we should be delivering that. We're very close to that already. But like with other parts of the cycle, you'll see that it's quite lumpy. And so we've delivered over 16% of target returns, but it doesn't all come in a linear way. This slide shows you how those returns break down by the multiple of invested capital or multiple of invested capital on the outturn. So when we sell these companies and we get cash coming back in, we'll obviously look at the cash reinvested versus what we delivered. 380 million, this is based on the previous number, 525, but 380 million of that comes in this 3x plus. So when I talk about venture being skewed to the winners, what we need to do is identify good companies, get in there early, sit with them on the journey, but then make sure that we're staying with them and doubling down on the best companies so that we can achieve these outsized returns. And our model of being evergreen does allow us to therefore sit with those companies for longer. When those companies exit, the majority of those have been trade sales, and in some instances we've had IPOs. So Trustpilot is a company that we owned 14% at the time of its IPO 3 years ago. In the other categories, you'll see that we'll have zeros, so you'll get no money on the left-hand side, and that's about 18% of our invested capital. And then you'll get less than 1x on another 24%. So this is a risk model. These can be good companies, but you can have problems with the timing of your investment, obviously, the timing of those companies coming to fruition, or the companies making decisions where they raise a lot more capital along the journey and you're pushed down in terms of your equity stakes, or taking on too much debt, as can sometimes be the case. And I would say that actually the time of the management team, a lot of it's spent in these two middle cohorts. And that's because those are the companies that we identify are valuable to somebody. They still have inherent underlying IP, they still have strong margins, but they aren't going to be the winners in this category. They're not growing quick enough for venture capital returns. And so we spend a lot of time making sure that we can move those businesses on, getting successful outcomes for the founders, but also to make sure that we can recycle the capital, and crucially that our investors who are sat on the boards of those companies can go on to the next opportunities as well. So managing the portfolio is a crucial part of the skill set. And I think when sometimes a misconception when I'm speaking to public market investors about what we do, certainly from the period of 2016 when we had a bit of feedback saying, well, we're stock pickers, that's what we can do. But in this market, getting your money into a deal at the right price is one component part, but then living with those companies for 7 to 10 years and then working out from a portfolio perspective how to manage your exits to get those returns, that's where the real skills come in. And I think we've seen a few circumstances where it proves that over time you really need to have that depth of experience. Just a couple more charts. So I touched earlier on income and costs. The left-hand side here is our costs in the salmon pink, and then the fee income that offsets those costs in the blue. So we still have a bit of a fee drag within that, but if you compare that to private market funds at a 2% management fee, it's substantially less than 1% for us because we have that income from other strategies that we're able to offset that cost base with. Obviously, as we grow third-party capital that's non-balance sheet, we can get to a stage where that can equalise as well over time. And then on the right-hand side, we're showing the evolution of the NAV as we scaled the balance sheet. And then clearly you can see in the last couple of years as that NAV per share has come down as the market has shifted for technology valuations. But I think the importance of the data we are able to now show in the public markets is showing that consistency over time and how the sort of through the cycle returns play out. So the final slide that I wanted to share with you was really thinking around how we look at an investment thesis. And a great example of that is how we thought about the fintech space, the technology that's underpinning people wanting to bank on their phones and having greater access to the financial markets led to a cohort of fintechs, if you like, neobanks. Revolut now being the key winner in that space, I would say, but also N26 out of Germany. And then you have other players like in Latin America, Nubank Holdings, which is listed in the US. And so we looked at this and we thought, well, okay, the first iteration of this theme will be consumers wanting a good user experience, so differentiated from what they get from their existing banks. And then they want something that's fast to transition, accessible to them whenever they go, when it's in their pocket. And so we started to look at the flow of funds. So where will the value accrue within that chain? And so we put our first investments into companies like Revolut and N26, but we also looked at the democratization of capital, bringing more people into the ecosystem. And so we looked at companies like Crowdcube, which allows investors to put capital into private companies through pitches on the Crowdcube platform, and Free Trade, as I mentioned before, which is allowing people to trade stocks through the apps on their phone. And that was the first iteration of where we put investments to work, thinking around where would the capital go. But there was a second order effect of that, and we thought, well, how will the incumbent banks respond to that challenge? And this is where we started to look a bit more at the infrastructure layer and the cost base of all the banks and how much capital they're spending to look after their existing customers, but also why is it that they can't innovate as quickly as the neobanks, even though they've got these years of experience. And here, without going into too much detail, because you're going to get a lot more clarity from Form 3 in a moment, but looking at core banking systems with Thought Machine and then payment systems with Form 3, we looked at the fact that banks currently have all of their tech and their legacy tech, and it's all built on top of each other, and it's cumbersome, and there's inherent costs, and it's liable to fall over and got regulatory problems with that. But all of the banks owned their own tech. And so we took the view that there will be a time when the banks have to move to a third-party provider for that technology, and that third-party provider will be able to improve the technology, run all of the patch updates, ensure that they are best in class because they'll have enough customers by selling to multiple banks. And this was a thesis that we put our next layer of capital into. And I think the first investment into Form 3 was 2018, I think it was, which was the time when you were spinning out of Barclays. So with that, I will allow, and this is something we find at our investor days, and I certainly very humble about this. Actually, hearing it from the companies themselves is much more valuable. So with that, I'll hand over to Mike to give you a sense of Form 3.
where my imposter syndrome kicks in. I haven't got quite so many charts as I've seen. But look, thank you very much for having me and an opportunity to talk a little bit about our business and what we're shooting for, and I guess where Molten have helped us with that journey. So I guess if I'm going to do a couple of sort of geeky technology bits, but I think it's really important that we start actually with some fundamentals. And we all know this is true in our day-to-day lives, but I don't think this has been fully internalized inside the banking infrastructure of the world. And that is that the expectation for any form of digitization is that it is always on, and that it is always real time, and that it's fast and consistent and safe. And the world of payments needs to deliver that as cheaply, fastly, and robustly as possible in a geopolitical environment where people are shooting at it. And so the world of real-time payments across markets is here to stay. So there are something like 70 different pieces of central infrastructure in countries around the world deliberately designed to allow for financial institutions to transmit money on behalf of their customers in real time. That is increasing rapidly both in the number and the scale of those operations. So there are more account-to-account transactions in the world than there are card transactions in the world, by a factor of about 5. This is where utility bills are, it's where mortgage payments are, it's where loan repayments are, it's where bill splitting at the end of the day is, it's where sending money to your kids is, it's where the money from your grandparents arrive, it's where insurance companies pay out disbursements under claims. The ecosystem around account to account is super well established, but it's knackered. And it's knackered because most of the infrastructure in banks is really old. It's not a little bit old, it's really old. There are systems running in tier 1 banks that were written in the 70s, and they're still using them at industrial scale for account-to-account transfers. And so when the digital economy, whether that is AI-driven or not AI-driven, crashes into the bank landscape, it doesn't really matter how good the challenger banks are. Their volume is a rounding error in this environment. In most markets, 80 to 90% of the volume that's operating in account-to-account is a handful of tier 1 banks, typically universal in scale, with many tens of millions of customers each. That's where all the volume is. And these are exactly the organizations that were there when it started for the first iteration of account-to-account and now the journey into real time. And they got some problems. And they're spending their way out of it, or they're trying to spend their way out of it. And I think Luke earlier was talking a little bit about this in terms of the cost-income challenge that exists inside banks. Something like 80% of the technology investment spend in banks is just to keep the thing working. And it is as blunt as that. So even 2, 3, 4, 500 million pound technology budgets in the payment ecosystem of tier 1 bank is just to make sure it doesn't die. It's not to make it better or do a Bitcoin shiny or work out what they're going to do in the Internet of Things. It's to make sure that your salary arrives, and it's to make sure when you initiate a payment that you're not sat watching a spinning wheel of death on your iPhone wondering why it doesn't work quite so well as a tap and go. Yeah? But the amount is staggering. So these are annual spending numbers from the top tier banks. So in the world of just connect me to that landscape of payment ecosystem and manage a payment flow, something like $15 billion a year is going in from banks. Every year, year after year, at 80% to keep it working. Something like $60 billion a year is being spent by these organizations broadly on who the hell are my customers? It's a bit staggering, right? But nonetheless, who are they? How do I make sure I keep myself safe? How do I avoid fines? How do I really, really know that I'm protecting the ecosystem that I'm responsible and deeply regulated for? Yeah? About $100 billion goes on a calculator that says, when you sent that money yesterday, your balance went from X to Y. $100 billion a year on calculators. Yeah? Now, what's interesting about this ecosystem is this is also where you have to make sure it's done correctly. You have to make sure you can reconcile this stuff. Actually, some of these transactions are super complicated, so they're not just a subscription that comes out every month. It's a variable subscription that's moving against loan calculations, and is that loan calculated daily or hourly or monthly, or so they're calculators, but they're quite complicated, right? Large numbers of banks don't know what will happen if they turn off their current calculator, because what they've done over the course of the last 40 or 50 years is protect the calculator by wrapping it in cool shiny things at a rate of $60 billion and $15 billion a year. Yeah? And if you wrap all of that together, the revenue streams that sit around these are something in the order of $1.5 trillion a year. This is what the ecosystem of payments is creating in revenue from their customers, which they're then funneling back in at an extraordinary high level to keeping the lights on in these pillars of technology. It is somewhere in the realm of batshit crazy. Yeah? Their bespoke technology is in big trouble. Every bank has solved that problem differently. A tier 1 bank is effectively a market of one. Their customer base is different, their geographic footprint is different, how they emanate their way to their size is different, the markets they operate in is different, who made the decisions on their technology, when they went in, when they didn't, when they started a product, when they didn't start a product, whether they are a card shop or not a card shop. Every tier 1 bank on the planet is effectively a market of one. And so what they've reacted to that market of oneness with is, I'm special, I'm going to build some stuff myself. Yeah? Because only I know. We disagree. Why is it broken? It's broken because the world of monolithic architecture and monolithic software development is really, really not where you want to be in a fast-paced change environment where new competitors are trying to kill you from the cloud. So I have worked in large banks before, and it would cost something in the order of $2 million to just create a test environment to work out whether the thing I wanted to do was going to work or not work. That's not the same as rolling out into production 15 times a day. It's just, you could not describe a technology landscape further apart than the legacy payment infrastructure of tier 1 banks and the real world of now streaming, cloud native and consistent and continuous development. But the regulators are after them, and they're after them because this stuff cannot break. So it needs to always be on, and they're checking. They're also testing. So one of the other things Luke was talking about before in his view of cost income is, to what extent should you have operational capital in a bank? So should you be holding money on the off chance that your technology breaks? In what industry do regulators create environments where they're so concerned about your technology stack that they are contemplating making you hold money on the off chance that you didn't get management of it correct for your customers? Cost income ratios are in trouble as a result of this. They're broadly flat. Thankfully, Luke did a chart. I don't have to. That's great. And there's loads of new shiny stuff, and they can't get at it. Like, you can't get at it. As a tier 1 bank, your ability to opt that and then distribute it consistently en masse to 30, 50, 80, 100 million customers in multiple countries, game over. Yeah? We covered this, but the new entrants are being super sneaky. And the things they're gunning for are the high margin customers that these banks really don't want to lose. They're not after scale. The scale is stuck in tier 1 banks. The people, the organizations that are coming up on the sides are nibbling around the edges and taking all the high value, high margin products from these large banks whilst they try and work out what to do. So we're going to have a go at fixing some of this stuff for as many of them as we can by building and running a payment platform that these banks connect to, so that the infrastructure and the management of those payment flows is done by an organization that just does nothing but that. And we just do it really well. And we do it big. There isn't really anybody else having a go at this, because it's also a little bit crazy. And there are a lot of organizations in the legacy environment who have consistently been the recipient of that spending profile. So we've had to engineer ourselves and create a franchise which just operates completely differently to a Fiserv, an FIS, a Finastra, an ACI. Yeah, and that's typically the software that is running inside these large organisations. So I thought, I've gone a bit techie, it's gone a bit wobbly. Let's think about a digital challenger bank for a second. Apologies, it is sort of loosely technology topography, but let's go for it anyway. So banks surface channels to customers. So think mobile app, think web front end, think file transfer for big corporates, yeah, channels at the top. Most banks have loads, not one. Bad problem, right? A new digital challenger bank has got one, and it's a really good one, and this is the differentiated user experience that we all know and love, which is why we've probably got a primary bank account with a really big bank because we think they're safe, and a second one we use all the time because the digital experience is just really cool. There's a few nods and grins, but this is the norm, right? So a digital challenger bank has one of those. They have a new shiny calculator, core. They have a couple of systems that will manage the catching of, I want to make and receive the movement of money. They'll process it because they're going to do some checks like, has the bank even got enough money to make this payment? Are we on? Does it work? Have we got enough of that currency? All that good stuff. They'll wire it into the central infrastructures of countries, but even digital challenger banks typically will have a stack per payment type. And that's completely normal because each payment type behaves a bit differently. Ta-da! We do that. Okay? That is an actual technology diagram from an actual tier 1 bank for one payment type in one market. Yeah? This is all the stuff that nobody ever sees. And this is where we play. Okay? You can see why occasionally they send you a message that says, we're going to turn it off for a few hours. We're really sorry for the inconvenience. We're going to do some stuff and it might come back. Yeah? This is why. Yeah? So, same diagram. Same diagram from a bank that operates in more than one country and probably has a few different types of customers. So not just some consumers, right? These guys have got genuinely a web app. They've got a couple of them probably. They've got some consumer apps. They might even have more than one consumer app because there's probably a wealth one because you're special. And then there's a non-wealth one because you're not special. And then there's some branches, and then there's some files, and then there's all this other stuff. And then if they're really cool, some bank somewhere will tell you that they've got an API. Good luck. And then what they will do is they will take that and they'll bung that into a bunch of different calculators because there's probably a calculator for the mortgage book, a calculator for the credit card book, a calculator for the loan book, a calculator for the currency book, a calculator for the domestic large-scale retail book, loads of calculators. Loads of can we catch and make money move. Do some processing, plug it in. This diagram is for if you were going to try and do a ish universal bank in just the UK, Europe and the US. Just 3. Okay? So, here. Okay, we get the gist, right? If you're one customer, this is cool. Always on, because we run 24/7, cloud native, built from the scratch. Always big enough. So one of those previous little boxes on that horrible, god-awful diagram, if that runs out of memory, payments stop. If the box goes, payments stop. I have seen banks on eBay buying bits. Always current from an industry perspective. This is really important. So the regulators are going for these guys, right? Can we do more formats? Can we transit more information? Can we do that in a slightly different way? Staying current across that previous landscape is really hard. You've got to cut these guys some slack. So the people who are in banks today are not the people that created those god-awful pictures 30 years ago. They've inherited some of this stuff. So this is also why you see some slightly stressed CTOs in banks, right? Because they've got to try and unpick it all whilst it's running. This is like trying to change the wheels on a Formula One car on the track at the same time as no customer feels it, whilst a regulator is telling you, do not fail. Under any circumstances, zero tolerance. Yeah. You've got to design in security because the bad guys are coming hard. I mean, this is not pretty at all. Pretty. You can design into new technology, new architecture, zero trust, and very high quality technology that isn't guard the perimeter. It is guard everything all the time. Yeah. You can't do that in a legacy piece of technology. Your total cost of ownership goes down. Most banks don't know what it costs them to make a single payment. They don't know. They can't work it out. Don't know. Too hard. You do know if you take the previous diagram of all the spaghetti stuff and you replace it with a box, I'm going to charge an amount per transaction, and it's just that, and you know exactly what it is. Yeah. And when something new and shiny comes along, I'm going to build it and I'm going to apply it to all my customers on a platform. Yeah. But we built it in a coolio way. So for one customer, it's compelling. We built it on one platform, and that means that all our customers connect to the same thing, which means we're kind of getting a bit warmed up with what can you do with loads of tier one banks connected to the same piece of technology. What else could we do? First thing we can do is every time we make a change, it's shared for all our customers. They all get it. There's no versioning rubbish. There's none of that stuff. It's just there for them to use. So we're mutualizing that cost and sharing it across our customer base. They and we know it will be ready for the industry, because if we're not ready for the industry, all our customers will go dark. That's bad, right? So we will be ready on time, every time. Some of our banks are waking up to the fact that they might be able to use our platform to send messages to each other. That would be pretty cool. We can do that. It's not our problem, but they need to work out what they want to use it for. Maybe they want to share some extra information to kill fraud that they can't currently get to each other. If you try and take all those bits of spaghetti and work out how one bank sends their spaghetti output to some other bank's spaghetti output, it's really hard, right? So they might want to use us for that. All our data for all our transactions is exactly the same for every payment type for every customer, and it's in one place. We think we might be able to do some interesting stuff with that. Most notably, we're going to shoot at the bad guys and try and kill the fraud. Yeah? And we've had the opportunity to invest in resilience in a way that no tier one bank can afford to do. Mostly because we spent all of Ben's money. Thanks, Ben. Wisely spent all of Ben's money. So here's an example. So a payment scheme in a country says, I'm going to do an upgrade. Did it in Europe. We did it for 10 customers, arrived bang on the date, as it should have done. 5 man-years worth of effort. For us, one bank, 200 man-years, 6 months late. Yes! I've got a fan of one. It's good. I feel like I should have like those DVDs and a little thing at the end. It's all good. Right, okay. We can spot on our platform at north of 90% fraudulent transactions between two parties on our platform. North of 90%. So we would think it'd be quite a good idea if they asked us to turn it on, right? This is over and above what the banks already think they're catching. Going to talk about resilience. We built this shiny thing. So back to Ben's point about IP. If you're going to do it, like, just go all in, right? So we went all in. So we run actively across 3 public clouds in real time all the time. So what that means is that when a tier 1 bank hits us with a transaction and says, make it so, if we were to lose all of AWS in 3 availability zones completely at the moment they gave us the transaction, the same transaction would complete in real time out the back end of GCP, and their customer would not know. And the other way around, and on the way in, and into Azure. Nobody has deployed technology like this in banky land. No bank can build this. 2 different tier 1 bank CTOs told me it was impossible. It's now in production, running about 20% of the UK. But it's hard. So our engineers are a bit world-class, super geeky, sit in their basements, completely remote, build ticketing services, built airline booking systems, built streaming services, built search engines. Geeks. Brilliant. But I guess the other thing that's very interesting for us is, I guess we think about innovation in a way where you don't change it all in one go. So one of the ways we think about this is the continuous change in the way we talk to our customers. So some of our biggest customers are also investors. So we have financial investors, we have strategic investors. They sit on an advisory board for us. They help us navigate where do we go next, where should we invest, where are our big problems, all that good shiny stuff. And I guess we really start to think about prioritizing not just technical excellence, but also commercial value. Where are we today? We are contracted for 50% of all the payments in the UK, and we're just putting it on. We're 8 years old. It's not bad. We'll take it. 350 people, so it's not super heavy, but it is infrastructure, and it does take quite a long time, and banks don't buy nice. So we work really hard at working with big, complicated banks to not upset them when we show them this picture and say, would you like a slightly different shaped picture? Yeah. We do this completely remote. So our 350 people, we have one office with 25 desks in it that some people turn up to very occasionally. The entire organisation, built remote, runs remote, has always been remote, nothing to do with COVID. 33, I think it's now 35 customers, and we're running at about, by the time we get to March, we will be running at about 5 billion transactions a year run rate, which is about 1.3 trillion pounds every year. That's the exit run rate. I think it will take us about 12 to 18 months to double that to 10 billion, give or take. These are our customers. Pretty cool. You can read all of those. I guess what's really interesting for us is same code base, same API, same platform, works for PayPal, works for Square, works for Stripe, works for Klarna, works for JP Morgan, works for Lloyds, works for Nationwide, works for Goldman Sachs, works for Santander. Same. And so whilst it does take us quite a long time to persuade a really big ugly bank to give us their business, what's really good about it is that not only are those key bank customers interested in this, Visa and MasterCard are also customers of ours and investors in our business, because they also know that the world of account to account and card will converge over time, and technology assets that are working like this give the world the best opportunity to think about some really cool user cases. Yeah. That, I think, I don't know if that was it. Oh yeah, investors, people who give us money. Sorry, Ben. Last slide. Should have started here. Play to your audience. These are the people who've given us money to have a go. Our expectation is most of the big customers that use us in really big domestic home markets for all of their customers will probably end up also being strategic investors. And this is a well-trodden path for payment infrastructure. It's how it's how the original card scheme started. Visa particularly. It's how Vocalink started as a business, if you guys are familiar with them. This is a well-trodden consortium-driven business. We're not a consortium-driven business, we're a commercial business, but that helps us to navigate some of the challenges in the market for regulation and use of tech. This is what we do. Is that all right? Benza.
I just find it curious that Visa and MasterCard has invested in your business, because they, as we all know, take a hefty margin between client and vendor.
Yep.
And experience taught me that the margin on these things is very low. How do you think your clients will deal with significantly low margins?
So the entire account-to-account market works on per click, not ad valorem fees. So the card infrastructure is percentage of value. The entire account-to-account landscape is per unit fee. The reason Visa and MasterCard are interested in this is because they also need to plug into these same sets of systems, and they're also trying to work out how they can talk to their bank customers about doing things that aren't just card. So they are trying to build sort of networks of networks, and we become a technology partner for that. So our customers are from our perspective, really, MasterCard and Visa are a customer just like a JP Morgan or a Lloyds would be a customer. And all of our investors are all minority shareholders. It's really important for us, because if we become the dev shop of a bank, game over, because we will just start building back to this legacy platform view of build it special because I'm special as an individual bank, and they clearly are special as a customer, but the solve for this market is do it once and distribute to many in a consistent way. So we've never had any pushback from existing customers or future customers about Visa and MasterCard being part of that journey.
You must hear many stories like this where you think, my goodness, I just want to invest. How deep a dive do you need to do to really understand if it's going to pay off 3 times or 10 times? And how successful have you been in not investing in the ones where you got nothing back?
It's a good question.
Thank you. I'm here all week.
You get very excited about the tech. It's true. So the technology is often exciting, and quite often you can see the market opportunity. It makes a lot of sense. Timing of your investment is the key, because timing kills most deals. So if you get into, let's say you get into an interesting company in the early 2000s, a lot of what we're investing in now were ideas that existed then, but the infrastructure wasn't available to make them come to the fruition. Whereas now you can go to the same ideas and they make a lot of sense because you've got the compute power that can sit behind them. What is still true though, so if I think about quantum computing as another example, that we have a software company that sits across quantum hardware. So we're thinking about this, the same technology stack that existed previously, but it's underpinned by quantum. You're then saying, well, okay, this is an interesting theme and it's an interesting market, and clearly value will be created. How do we as a house want to play that theme? Do we go and choose the hardware player and get into the science and say, these guys know better than this one? That doesn't tend to play out very well. So what we've done is to say, well, there's a software layer that supports all of that hardware. And so really we're thinking about playing the infrastructure. So we're playing the thematic, but we're doing it by trying to play across that theme. And we've done similar things with blockchain security, where we went with the security layer rather than picking an underlying cryptocurrency winner. And we say, okay, actually we have a company in France called Ledger, which creates the wallets that give you the security around that infrastructure. That's the way we try and play those thematics. So your point about timing is really valid. You can get super excited when there's plenty of investments that we've made where you get the timing wrong because the market changes, regulation changes, the incumbent players adapt to what's happening. And so only really 30-40% of the time are we getting it right and getting the outsized returns. And that's why venture is a model where you really have to manage that portfolio, and you also have to play across different vintages. Thank you.
I would, not because he's just stood here, I would add, we thought really hard about where to take money from, because money is money. And actually what we need is people who are understanding the nature of the industry and the fight we're trying to pick, and who will sit on a board and help us to do that. And you find out really quite fast whether somebody's got a checkbook or expertise, particularly in the VC community. There are lots of people with checkbooks. The expertise varies quite a lot in different sectors based on the themes they're trying to pick. Yeah, and so this was a good match of hypothesis and thesis from Molten and where we wanted to take our business. Other organisations, very, very tiring and labour intensive to try and educate on a whole market and why you're trying to do the things you're trying to do. And that just doesn't really add any value. And so we've always tried to think about that sort of capital structure from the value of expertise for us.
Is this technology that you're using completely different to blockchain?
Yes. 100%. So the blockchain is not capable of dealing with the speed or the volume of that real-time account-to-account landscape, and it's too expensive to run for that. So this is a all-current tool running public cloud, applied to this very specific kind of problem in banking where they're just using much older original versions of mainframe technology and software written in languages that people can't even write anymore. So it's blockchain. There's no reason why our platform couldn't start to think about connecting to blockchain, but our business model is all about scale, and there just isn't enough of it in blockchain.
And your strategy, Ben, is that rather different?
Well, we will look across the portfolio at different stages of maturity of those companies, but the majority of what we realise will be M&A. So it'll be sales into large corporates. So the scenario that Mike outlined there, where people want to buy in the technology. We are also happy for an IPO process if that's the route that the company wants to go down and it creates the best value. Ultimately, we will look at both paths at the stage that it's right for the business. So we're agnostic in terms of what's right for the company, but it's actually a preferred route for us generally, as a generality across the portfolio, to have M&A, because we'll get our cash out earlier. We won't have the vagaries of the public market. We won't have a lockup. So that tends to be that we prefer to do that.
So, Mike, are you going to be another brilliant UK tech startup that ends up in the hands of the Americans? That's where they've all gone.
Don't know. Don't know. Don't know. I think it will depend a little bit for us on how successful we are in the US from a product profile and a customer perspective. So, we're super successful in the UK. We've got quite a lot going on in Europe. We've just started in the US. I think the answer to that will be how rapidly can we grow in the US and how relevant do we become in that market? And then I think that would be not an unreasonable outcome. I don't think we would push to the US just because that was a financial decision. I think that would not help our tier 1 client franchise. Every month we hit delete on the platform and we wipe it out and we rebuild it whilst it's running, and we do it every month. And so the ability for us to keep going regardless of what is happening to us is extremely high. Banks can't quite unpick themselves like that, so they will try to achieve no interruption, but sometimes it's just technically not possible to achieve non-interruption because of the technology they're coming from. The new stuff they put in that wires into us and plumbs into us wouldn't have that as an issue.
Hi there. Are you original founder, and how many other founders are there?
I am. Okay. Sorry, the question was, am I a
original founder of the company, and how many other founders are there?
Yes, we 3. Yes, CTO still in post, and exec chair.
Still friends?
So far, yes. It's going okay. We've not had a reason to fall out. Yeah, it's hard. I mean, it's doing that. You do have to be slightly mad, and it's really hard. I don't know if I know I'm preaching the converted. What the reason? One of the problems you don't want to lie awake at night worrying about is access to funding on real world problems you really want to go for, right? But I don't know if anybody's seen that thing that went round on LinkedIn, which is, the guy running on a treadmill while somebody's pouring Lego onto the treadmill. I don't know if you guys saw this. Starting a company shooting at these types of customers with this type of technology in this type of market is like trying to dodge all the landmines whilst they're moving, whilst you're running, right? It's really quite hard. And I think we've met a lot of investors and current investors where I think they recognise that some really strong groups of founders have a much higher probability of success because it's that hard, yeah. And so being able to work through problems and approach it from a different perspective is really, I think is really important. Yeah.
I think where you as a group were also differentiated is that you had experience working in your customer base.
Yeah.
In the big banks, you knew their problems, you knew how they would go about solving them, so you could see the solution. But that also doesn't necessarily mean that the journey is any easier, because you still got to get funding, you're still taking risks on how they're going to behave, how regulation is going to change and behave. So I think the plaudits for the people that take the risk and the entrepreneurs, even when they're not successful, they're still creating jobs, they're still creating innovation, productivity. It's massive.
Yes, sorry, last question. Are you also responsible for the cybersecurity?
Am I responsible for these?
Cybersecurity.
I have a chief information security officer and a team of about 50 people whose job it is to protect the platform that we run. Yes, absolutely. Yeah, it's you don't want to talk to him at a dinner party. The world is really quite scary. The world is really quite scary. But I think, again, if you go back to what is the technology solve, I can't emphasize enough the difference between the old world of technology and cloud native as a technology. Like, I can't emphasize this enough. It's completely different. So security is a really good example. So banks used to have vaults, like doors, and then they started building some technology, and so they did the same thing, right? They built perimeters around it, like you would build a vault or like you would guard the doors on a branch. Why wouldn't you? And actually, for legacy tech, that's okay, right? Problem with that is if you get in, the bad guy walks out with all the money, and it's really hard to stop it because you've protected the perimeter, but your ability to protect all of those interfaces and internal activities is really difficult. What is really interesting about a cloud-native microservices architecture is we have something like 400 different services running across these public clouds, and they each operate on the principle that the thing that's trying to talk to them is a crook. So every single message that runs between these different services doing different things is all encrypted and believes it's trying to get hacked. And so if somebody gets into one of those boxes, it doesn't mean anything. We don't even know the address of our data centers. Like, we don't know where they are. Like, we couldn't break in even if we wanted to. In fact, I think today the UK government has just designated key data centers as critical national infrastructure for this reason, right? Like, they don't exist. So I think one of the things you can do today that you couldn't do before is design in whole new levels and whole new types of security that it's very, very hard to retrofit onto old technology. Which is why these guys, I think with 15, 18 tier one banks, every year, they just come and beat the shit out of us. Every year, right? And they have hundreds of security people to make sure that the way we do things is actually better than the way that they would be able to do things in-house. But it is an existential risk to the operation of economies. Yeah. Not us specifically, but just this is a problem. Yeah.
Just one question for me for Ben. I know in your presentation you talked about that Europe is not the poor cousin of the United States. I appreciate it's probably an expansive issue, but why has Europe failed to produce an Amazon, a Google, Facebook?
My simple answer to that is capital. So a lot of the IP that we're creating in Europe, a lot of the entrepreneurial talent can raise seed capital in Europe, and historically maybe would struggle to even raise their first rounds of capital. But to raise any significant amount of capital, they'd have to go to the US. And so if you look at an iPhone, a lot of technology in there will be European technology, and the people that develop the iPhone and develop other technologies out of the US will have been Europeans moving there. So the capital has been the big factor. Now, I think that has improved, but there's still a long way to go, particularly at the stage where we invest, where it's not the very first round of financing, but it's what we call the early growth stage. So you've still got risk within the business, within the model. You want to be able to write 20, 30, 40 million pound checks consistently. There aren't that many places you can go to for that. And so, to my mind, it's not a lack of talent and not a lack of IP. You could argue the culture of entrepreneurship has increased or improved over the last 10 years. So I think that's a factor in itself. But the key factor is capital. And a lot of the work that's happening now in our country, but also across Europe, with unlocking pension capital, recognizing that pension funds are regulated to go for the lowest cost solutions, which means that more often than not, they're just buying government bonds. And then lo and behold, pension members don't get to retire with the incomes they thought they were going to get. So pension funds have to be able to take more risk. That applies to public markets, and it also applies to private markets. So one of the summits I was involved with last week is on the back of the British Venture Capital Association, working with the government, with and the pension providers, looking at how they can unlock pension capital. And that will be quite a step change in our ecosystem over the next 2, 3, 4, 5 years, as a lot more capital will come into the private market sphere. Now, that change happened in the US in the late 70s, early 80s, and that's why their US VC ecosystem is so well pronounced, because the pension funds have been investing there for a long time. And if you look at UK VC funds, 80%, 90% of the capital is coming from Americans, Canadian pension, Australian pension funds. We're just not funding our own. That will change.
We will now have a short comfort break. Please feel free to grab a cup of coffee whilst you enjoy the short videos we have lined up for you.
Protecting planet Earth has become more and more important in the past 2 decades. And as the custodians of planet Earth, it is our responsibility to look after the environment. For the last few years, we have been using the United Nations Sustainable Development Goals as our guiding light. We have signed a pledge to uphold the principles of these goals, and our alternative investment strategy is part of our commitment to building a better future for generations to come. When you invest, you commit to your future goals, and so responsible, sustainable development and responsible investing are interwoven. Umoya means wind, and today we've traveled to the incredible West Coast to visit the Umoya Energy Wind Farm. We are proud to be a part of this partnership together with other institutional investors, and today we'll be meeting with stakeholders to see how we are all working together to invest in a sustainable tomorrow. Sabri, tell me a bit about the Umoya Energy Wind Farm.
So the story starts way back in about 2008.
Yeah.
When this land was actually purchased to explore phosphate mining. But at the same time, the renewable energy industry started picking up in the country.
Yes.
And then obviously the shareholders and investors thought, why not explore that avenue?
So how big is this project? How many people do you have here? How many turbines do you have?
Yeah, so the number of turbines obviously is linked to our power purchase agreement. So we were awarded a power purchase agreement to supply about 65 megawatts. We ended up with 37 wind turbines with a capacity of 1.8 megawatts each, and that is all able to then supply at full power and meet the demand of our power purchase agreement and our contracted capacity. The turbines are, when you look at them, quite majestic, standing at about 95 meters high to the hub. So the hub is the area where all the blades converge. One blade is 49 meters long. It weighs about 7 tons. The nacelle, which houses the rotor that's connected to a gearbox, which obviously multiplies the speed of the rotor. And then that's connected to a generator, which generates the electricity. And then right in the back of the nacelle, there's a transformer, which then steps up that electricity from about 690 volts to 33,000 volts. And all of that energy is exported via underground cabling to our substation, facility substation. And then that is further then stepped up from 33,000 volts to 132,000 volts, which is the capacity that the national grid is operated at. We're able to power about 29,000 medium income homes, or about roughly 70,000 low income homes.
So how many people do you have here, and how big is this project in terms of running it? So you're the boss here.
Yeah, so During construction, there was quite a number of contractors on site.
Yeah.
But during operation and maintenance, currently on site we have the principal contractor, which maintains turbines and all of the electrical infrastructure. Then we have a full-time security service provider and environmental management contract as well.
Yeah.
So in total we have about 15 to 18 staff members on site every day.
Who benefits directly from the energy that you produce here?
So the energy that we produce is exported directly into South Africa's national grid.
And your partnerships, you have partnered with the West Coast National Park?
Yeah, so we did, and that is all part of the round one bid proposal that was submitted for us to be able to construct this wind farm and to meet our obligations under our environmental authorization and agreements. So we've entered into an S20 or an offset agreement with the West Coast National Park or Sand Parks. Roughly half of the land that was bought has been designated as a conservation area, and that will eventually be absorbed into the West Coast National Park.
And what about the community around here, what the impact and the benefits?
So as with all renewable energy facilities, there's an economic obligation that we need to meet, where the IPP plows back into the community, but there's a designated area, so it's within 50 kilometers radius of the facility. I think over the past 7 years there's been an excess of about 30 million rand plowed back into communities, and these are some of the most historically disadvantaged communities that our economic development and our social enterprise development team sort of works in. To be in the middle of the environment all the time and all you leave is your footprints. That's it's something very nice to experience and close to your heart. Yeah, as well. Yeah.
Standing under these huge turbines, I'm incredibly humbled by the beauty. But at the same time, I'm filled with hope that through partnerships and commitments like this one, we can all build a better future. Because with us, investing is personal.
We believe that investing is personal, and as part of our commitment to building a better, stronger South Africa, we are committed to the uplifting of communities by providing opportunities across the country. Our bulletproof malls create hubs in communities where people can gather and where they can have convenient access to shopping. But most importantly, these hubs allow for economic development and job creation. As a business imperative, our investment in these malls are an attractive opportunity for investors to diversify their portfolios and generate long-term returns. These locations form part of our Impact Fund range, where we have aligned our impact strategies with 6 of the UN's Sustainable Development Goals to drive results, including Goal 7, access to affordable and clean energy, and Goal 8, promotion of decent work and economic growth. Our mall location delivers on a number of key strategic goals, like real estate, where our solar partnership can generate electricity and in so doing, help provide additional revenue, reduce costs for our tenants, and provide clean, renewable energy. Being part of a community and investing in a community where our clients live and work is what keeps us committed to the growth, sustainability, and the future that uplifts the people of South Africa.
Hello everyone. Hello again. Good to speak to you yesterday, and hopefully you enjoyed that sort of pre-insight into what we'll be talking about today, where we were talking about private equity yesterday. So today we're going to be talking about the new fund that we launched earlier this year, back in April, called the Real Assets Growth and Income, which because as you know, we love an acronym, that is RAGI. So if you hear that mentioned, that's what we're talking about. So what is RAGI? Well, it's essentially a Luxembourg registered fund. What we're looking to do is target a real return of 3 to 4% per year. So in nominal terms, looking around 8%. But that's obviously over the cycle. Can't guarantee that every year, but clearly over the medium-term cycle, that's what we're seeking to do. And of that return, a fair chunk of it is an actual cash income yield. Indicative around 4.5%. It's currently around 5%, given where current yields are very attractive at the moment. But a large proportion of the return is income. And the key thing is it's highly diversified. Whilst it is the number of holdings within it, number of investment trusts, which we'll talk about shortly, is around sort of 30 or so. Those are highly diversified vehicles in their own right. And the largest single investment or asset would be less than 1% of the fund. These are operating assets held through an investment trust vehicle, and they're internationally located. So although the investment trust that we're owning are listed in London, it is internationally diversified, and those assets are probably only half of them are actually located in the UK. And as I say, we're accessing these assets via the closed-ended investment trust market, and the timing of the launch is particularly important right now for reasons we can talk about. So why are we using investment trusts? So essentially, if you haven't heard of them before, they're quite a UK-centric proposition. They're a closed-ended permanent capital vehicle. So whereas a fund is open-ended, you buy a fund, more units are created, it gets bigger. This is essentially a closed-ended, finite piece of capital, which issues shares on the London market, and those shares are traded. And those shares are underpinned by a value called a net asset value. The beauty of that is that what the assets it's owning are inherently illiquid. Okay, so clearly if it owns a property or a piece of infrastructure, that can't be bought and sold on a day-to-day basis, and the manager needs to manage that capital, knowing that he's got control of that for the long term. And so you're avoiding the mismatch of liquidity, of daily liquidity versus a fixed asset, an illiquid asset. So this share structure can boost returns also with moderate leverage. So we're not talking major leverage here, typically 20-30% LTV against asset value, well covered by operating earnings as well. So there's no sort of generic systematic over leverage at play here, and the illiquid assets are very, very sort of secure. They're often backed by contracted income flows. So there's very little sort of linkage, if you will, to GDP and economic activity variance. And you also have the beauty of an independent board, and that's really important, because if investors, shareholders don't like what's happening, or if returns start undershooting expectations, there's a body to go to and start affecting change. That's not something you would typically have with an open-ended fund. You don't know who the directors are, you can't get access to them. Whereas with a board of directors, you've got an accountability that is unmatched. So why now? Why are we investing now? So this is a sort of history of what's called a discount and premium. So as I said earlier, the shares are traded on the stock market. Now those shares, depending on the amount of supply and demand for those shares, will trade at a premium or discount to the underlying value. And this goes back, back to the 1990s. We've got the universe of investment trusts, which is the light blue, and then the universe excluding 3i. 3i is a pretty sort of special case in point. It's not generally treated as an investment trust by the market, but and it trades at a big premium. So the dark blue line shows that the sector has right now moved to quite a marked discount to net asset value. So that means the share that you buy in the market today is basically priced less than the intrinsic value of the assets that it represents. And there's various reasons for that. Right now, obviously we've had high bond yields. That's now peaking. Now starting to see bond yields fall. But that meant that sentiment ebbed away from the sector. Investors expected net asset values, which have a sort of an implicit linkage to bond yields. People were expecting NAVs to fall. NAVs haven't actually fallen that much because they've had strong operating performance, and the share price discount has over corrected for that. And then there's also been a huge problem, which I won't labour in this presentation, but on what's called cost disclosure, which is basically a regulatory framework which has been punitive, inappropriate, and misapplied to the UK investment trust industry, which has meant that a lot of investors are being prevented from actually buying this. And this is only something that's been in for the last couple of years. And fortunately, we've had news today that is actually going to change, in the very near future. So, that those things that are sort of causing the discounts to be so wide right now, high bond yields, misuse of legislation, and also the out of favour nature of the UK is all starting to change. I think the UK is now starting to improve its sort of reputation and perception amongst investors around the world. So investment trusts are on multi-year discounts. In various subsectors here, infrastructure sectors on a 19% discount, property 13% discount, private equity that we heard from yesterday, particularly oversold, 23% discount. So essentially you're buying assets for less than what they're worth. And that's just wrong right now. Those headwinds are starting to reverse. Bond yields are falling now. And the legislation is now finally catching up with reality. So what are the benefits of this sector? So we've got low correlation to financial markets. So what does that mean? Well, asset such as an off-toe, so let's say an offshore wind farm that generates power. To get that power from offshore to onshore, it needs a cable, a thick cable, and that cable is available, and that's owned by one of our infrastructure trusts. And no matter how much the wind blows or what the power price is, that as long as that cable is physically there and operating, then there's an income earned from that. So it doesn't matter, whether the stock market's gone down that day or whether there's been a war in Ukraine or whatever. That cable is physically there and operating, and so an income is earned by that asset. So it's not correlated essentially. Sustainable and diversified income streams, well, across numerous assets, different sectors, different asset classes. Some income streams are contracted, other income streams are maybe have some sort of linkage to demand, but basically what we're trying to do is ensure there's strong diversification across the whole portfolio. And a lot of those income streams are linked to inflation, either explicitly through contract, so linked to RPI or CPI, or there's an implicit linkage that over time, rental income increases, or the demand for an asset will grow over time. Some of these assets are quite niche though, so this is a sort of an area of challenge. This is not an area that you can just sort of buy and forget. You need to have regular dialogue with the investment managers and asset managers, and making sure that they're on point and doing what they're meant to be doing. We develop long-term relationships and trust with the asset managers that we own. Many of them we've supported since their IPO 10, 11, 12 years ago, and that relationship matters. It means that we have a relationship with the boards as well, have regular dialogue with them, and so there's just so much more engagement. Now that is heavy duty work. That's not something that retail investors can particularly afford to do or have access to. There is obviously an element of liquidity risk. So investing trusts, whilst they're traded on the stock market, the amount of daily liquidity can vary from day to day. So again, you have to be pretty much on the ball, making sure that you know what's going on and anticipate periods of poor liquidity, and discounts and premium to net asset value. I mean, that's a risk and an opportunity. If shares are trading at a discount, that's an opportunity. If they're trading at a premium, then that's a risk that they won't continue to trade at a premium, they'll move to a discount. And so this is where active management on our part really sort of comes into play. So the asset split here is showing the SAA, strategic asset allocation. So pretty well diversified across property, specialist financial, that's things like specialist debt or aircraft leasing, asset leasing, royalties, infrastructure around the world, all sorts of different types of infrastructure. Private equity, we saw an insight of that yesterday with Molten Ventures. So we have early stage private equity, later stage private equity, venture capital, growth capital, across the piece, really just to get a good, good broad exposure across 6 different managers we've got there. We also have defensive assets. Now this is used as a sort of shock absorber, if you will, to protect against that risk of premium and discounts blowing out against us. So that's things like gold, gold miners, physical gold, a good slug of gilts as well. Some funds that are uncorrelated, trades or volatility. I'm actually holding a VIX future as well right now, and a decent amount of cash as well. So 20% is the sort of the standard allocation to assets outside of the investment trust space. So this just illustrates what I was saying earlier, that the portfolio, although it's UK listed, it's not UK sort of focused. So UK based assets are only around half. The most UK centric is the property space, the REITs. The rest of the things like infrastructure and private equity, much less focused towards the UK. So this is just showing some of the holdings that we had at launch. We had an early win as well. It's not showing on here, but we had Hypnosis Music Royalties Fund. Was trading at a very wide discount, and basically that vehicle got bought up because it was trading at the wrong price, and the shares bounced something like 25-30%, I think, on the day that takeover was announced. But yeah, right across those 4, we've got different managers doing different things in different types of assets. When we introduce a new name, we're making sure that just introducing a new name doesn't necessarily increase diversification. We need to be confident that it's not doing the same thing as what we already have. And also, the more names you have, that's the more work. So if you over diversify by name, then you're actually increasing your risk because you've got less time to actually do some of that hard work that I talked about earlier. So engagement and governance is key for this space. Some investors make that mistake that, okay, it's a diversified investment trust. There's lots of different assets in there. Yes, it is, but you need to understand what are the factors driving the returns within that vehicle. It's not the same as buying a fund of equities, basically. So I'm just going to hand over to a colleague, Gary, who's co-manager with me on the fund, and he's got a couple of stock examples.
Yeah, thanks. Okay, so Richard's given you the outline of what we're trying to achieve and the asset classes that we're investing in. What I'm going to do here is a couple of stock examples, because I'm trying to demonstrate this is going to be a small fund. This is going to be billions in assets under management. We're targeting specific parts of the market, and we want small niche opportunities where there's a demand for capital, but it's not necessarily addressed by the hot money and the major players in the market. So the first one is Assura. What they do is they build, buy and rent doctors' surgeries, medical centres to the NHS and to the Irish health system as well. So I don't think many people will argue with me that an ageing population means that there's more demand for healthcare. There's probably not too many UK-based people here, but the NHS is under stress in the UK. It's been underfunded for years. A lot of the properties, so GP surgeries, a lot of them are kind of converted residential properties. They're not fit for purpose. And it needs updating, and there's an increase in demand. So they're looking for private capital to help with that. And Assura sits there. It's been a partner of the NHS for a number of years. It's built many properties, etc. As you can see from some of the facts, 4 in 10 of GPs are seeing patients in premises that are unfit for purpose. So hopefully with the Labour government, there might be a little bit more capital coming in as well. But essentially what they do, build, buy and rent on long-term leases to doctors, to walk-in centres, and essentially the NHS. The NHS is then backed by the UK government. And the market's been a very attractive one. So this is over the long term. So you've got the risk there. So, equity is the more risky end of the market. Office space can be more volatile. Primary healthcare is one that's been, demand has always been probably exceeding supply for the majority of the time. It's lower risk, long-term leases, well-backed rentals in the market, and the government cash has been there in the background. So at times it's served like a bond proxy to some, to a degree when interest rates have been low. But it's had strong returns, and it's done it with a low amount of volatility as well. I mean, long may that continue. So here's an example of the different types of properties that Assura will use. So a GP surgery, your doctor when you go for your daily your appointment for a basic illness. There's some private hospitals. You have things like in the UK we have walk-in centres, which is trying to alleviate pressure from hospitals. Instead of going to A&E or hospital, if you want an ECG, an X-ray, some basic medical care, they have walk-in centres regionally that take the pressure off the hospitals. They've been increasing over the years. Some private hospitals, the NHS is outsourcing a lot of contracts to private hospitals now, so that's a big growing industry. And then mental health as well, which again is a severely underfunded area. Look at the lease lengths, 21 years, 21, 25 to 30, 25 years. These are long leases backed by the NHS, ultimately backed by the government. So that's what you want. You have low risk of default. There's not many doctors' surgeries that go bankrupt, essentially. So you've got strong tenants, you've got long leases, so you've got high visibility of cash flows. That's what you want in an investment, but normally you get low returns for that. And that's the rent reimbursed direct from NHS. So ultimately, you put the government in the background supporting all of these different things. And the need for investments, again, not many people will argue, well, especially people in the UK, the healthcare sector needs improvement. It needs fit-for-purpose properties. And companies like Assura, they don't take the risk. They'll agree, they'll scope out a area where there's been population growth and it's underserved by doctor surgeries. They'll agree with the NHS or the trust what's needed. They'll agree what's to be built for purpose with the special recommendations and agreed with the trust. And then the rental agreement will be all agreed up front. Assura will have the building costs locked in. So it's not, they're not huge development costs here. So whenever they build anything, it's not speculative. It's all being agreed. and it's all got a long-term contract that's sitting there funding it in the background. What's the potential going forward? Growing demand everywhere, and then also significantly higher rents. We'll see in a minute that a lot of the rents are inflation linked, which is really important. Normally it's 1 year, 3 year, 5 year reviews. So the inflation period we've just been through, a lot of these rent reviews haven't kicked in yet. So we're expecting rental growth to be quite strong over the next few years as there's reviews in all of these properties that are already in the portfolio. And then there's a potential for acquisitions. They've just bought some private hospital. They bought a portfolio of them from I think it's a pension fund. But a lot of the GP stuff, they just build themselves. They build it from scratch. So why do we like it? What's it like currently? So Rich mentioned that there's been some structural issues with the investment trust market, one being the cost disclosure, interest rates, etc. Interest rates we feel are peaking now, starting to come down. So that'll turn a headwind into a tailwind. And the fee disclosure has actually been, there's news this morning that the regulator is now changing that. So the reason, the rationale for these big discounts in the investment trust markets, a lot of these issues are being taken away now. But the current discount on Assura is 14%. Now, for such a stable, kind of low risk investment, having a discount of 14% to the net asset value, to me, is huge. When interest rates were really low, when they were historic lows, this was trading at a 30% premium, 30% premium to NAV. And if you think about how sensitive the NAV is to interest rates as well, these are properties with contracts for 20, 25 years. So when interest rates went down, the NAV went from 60, 70 to it's about 48 at the moment now. So the NAV has already priced in the fact that we're in a high interest rate environment. The market has then put that in at a discount. So the NAV is at a low point in terms of the cycle. And then the discount is probably at a peak as well. So you get in this double effect. So if interest rates come down, which they are, if there's more expenditure in the NHS, the rent reviews kick in from the CPI-linked rent reviews. We think this is a brilliant time to own this type of investment. It's currently yielding over 8%. So 8% for what is a bond proxy, a govie with a little bit more risk is a brilliant. So you can lock in an 8% yield now, and then that rental growth should kick in. You can see over the years they've grown the EPS and they've grown the dividend as well. So we expect the dividend to grow as well. So you're getting an 8% yield now. You're getting a depressed NAV. You're getting a margin of safety with the discount, and you're hopefully going to get a growing earnings per share and a growing dividend. So to us, and it's a reasonably low risk investment. So to us, this is exactly the type of investment that we want. Small, niche. People overlook it. People are backward looking, and the price and the valuation is what's gone on in the past. The future is going to be different, and we think this is so. There's the lease gears and the rental growth. It's got debt. This is one with about, I think it's just around 40% debt. As the NAV increases, that debt level will come down. This is one of the highest debt levels in the whole portfolio. But that debt facility is secured at 2.3%. They've locked it in for a number of years, 2.3%. So the debt's not going to cause a problem with the current interest rates as well. Second one, so this is a more international one, biopharma credit. So this sounds a lot more scary than investing in GP surgeries and walk-in centres. First of all, the life sciences sector. So again, it's a huge growth sector, and it's not correlated with cycles. With as demand moves up and down in the industry, demand for medicines doesn't. If you're ill and there's a product available, it's going to get used. So the correlation with the financial market is very low, and it's a huge growing industry. We've got gene therapies, all sorts of different therapy developments coming through, and it's $1 trillion plus a year industry. Growing population again is a huge growth driver. As people get older, they need more healthcare. There's more diseases get research, and then more treatments will come from that. So what do biopharma credit do? They don't invest in companies that are developing. Well, they don't invest in developing medicines. So let's say a life sciences company. The riskiest part of the life of that company will be when you're putting you've come up with an idea, and you're putting it through the medical testing. It's about a 5-year phase. All you're doing is sucking up cash, and at the end of that, your product might not get approved. It might not be more. The efficacy might not be better than the current incumbents in the market. So it's about as risky as you get. You're ripping through capital, and you don't know what's going to go on in the future. That's not what they lend to. They don't lend against that. What these life sciences companies will probably do is they have one successful product. It's been approved. It's in the market. It's a market leader. It could be generating 200, 300, 400 million a year in revenue. And you can see that projected for the future as well, because you can see what's coming down the line. Because it takes so long for a new product to be approved, you can see 5, 6, 7 years what's coming in the future as well. So you can see that cash flow. If you've got a successful product, you can see it's quite secure. What these companies want to do, they want to grow. They might want to acquire someone else. They might want to buy new properties. They might want to develop a second product. You know, the research and development people come up with a new idea. But again, that's going to need funding. So you can issue equity. If your equity price is high, you can issue equity, which is what a lot of them do. But life sciences companies now is a low part of the cycle, so the equity values are rock bottom. So what you do is you look to the debt market. So so they will then secure that loan against the successful product. So the company takes the loan to be able to develop a new product, but the rights to the product, the successful product with the visible revenue stream, that's what the loan is secured against. It will be a senior secured loan against a successful product. Might be a device, might be a drug, intellectual property, anything, but the underwriting is really strong on this. Again, the life sciences debt market is underserved. I think a lot of people just don't understand it. These are specialist managers that only lend in this space. So banks will lend anywhere, but they don't have the specialisms in certain markets and the relationships, etc. These guys, this is all they do. They're that corner of the market. So long track record. They've had private equity vehicles. This is a closed-ended investment trust. So the manager has private equity vehicles alongside. They've had 4 successful ones with long-term track records. So fully realised, so this is in the current return, fully realised and generated 10.3% unlevered weighted average annualised IRR. And the return on the trust so far is quite similar. It's about 10% per annum. And what the trust will do is share with the private equity. So an idea will come through, go on the table of the underwriters. If it's approved, the trust might take 50% of the loan and the private equity vehicle might take 50%. And then it gets adjusted if someone's low on cash or someone, it might be 60-40, 70-30. So here's the examples of how the loans are structured. So maybe 5, 6, 7 years is the duration of the loan. Senior secured. They'll have a commitment and then it'll probably be dispersed over time. If you funded a new product, it might be 50 million in year 1, 100 million in year 2, etc. So you'll commit a capital at the beginning, then you'll drip that into the company. There's the share between the private equity vehicles and the trust. There's the cash balance of some of these companies. So they've got successful products there. The underwriters are always they're looking at the profile of the successful product before they make the loan. So these companies have got strong cash balances. So if you think about the risk of default on these loans, you've got cash generative product in the background. You've got a cash balance in the company. The company can repay the loan if they want to stop developing the new products, etc. See, there's the sales levels of some of the drugs as well. Some of them are exceptional. So a loan of 400 million, annual sales of 526 million, 316 million. So a lot of these companies don't even, they can repay the loan just on cash balances that are on the books already. Coupons are normally the overnight lending rate plus an agreed level. That depends on what the underwriters see as the risk. Or probably as high as they can agree with the lender. So it's a negotiation. You'll have a floor on the overnight lending rate, which we're probably not. I think it's about 5.25% at the moment, so we're way away from any of the floors. You can have bullets, or it can amortize, or you can pay interest only for the period and then start to pay it down. There's all sorts of different structures. Again, this is why the banks and some of the big players aren't getting involved, because it's very niche, very specialist. And then the fees. So when you first issue the loan, you'll get a 2% of the commitment back. Also prepayment, which is a risk, because what you don't want is all your loans to repay next year, and then you've got a huge amount of cash and you can't pay dividends to us as investors. So you'll have like a 2-year, 3-year make whole of the interest. So if, let's say, someone takes out one of these companies, buys them out and pays the debt off, you'll have to make whole 3 years worth of interest and pay a fee of 1, 2, 3%, depending on what age the loan is. So it's a protection mechanism to make sure there isn't as much of a cash drag if people because this is an area full of M&A, so there's lots of companies get taken out. Managers track record. So there's been 34 successful realised transactions. These are the IRRs. So you can see the 10 to 15% is where most of them tend to fall. A lot of these are floating, or they can be floating or fixed. The huge one up there was a loan that they made and then someone was taken out within months of the loan being made. So you had the make whole, you had the adjustment payments, and I think there was some warrants in the loan as well, because the underwriters were probably aware that there may have been a bid in the. So that's why the IRR on that one is so big, because it's such a short loan, and the fees and the warrants paid huge on that one. They've had one loan that's defaulted. So we've watched this for years, this trust, and we've liked it, but we haven't thought the valuation was being the right time for us. They had one loan defaulted last year. It was a medical device for doctors to test, like a COVID test. Instead of sending you can do a scan in the doctor's practice and get the results straight away, rather than sending it off for testing. And after COVID, it was it was going to go great guns. Lots of doctors signing up for this, but the doctors' budgets were restricted, so doctors didn't actually use it, and it was on like a pay-per-play basis. So the revenue that was expected didn't come through. The underwriters did the job right. The value of the underlying IP was still strong. I think it was bought out by Roche. So the loan defaulted. Roche bought the IP, and the recovery rate on the loan was 93%. And there's still a little rump of like some Chilean business that's worth a few million as well. So it could even be the recovery rate could be close to 100%. So very good on the IRRs, low defaults. The one default that they have had, there's been a really good recovery rate, so which is a test that we look at as a test to see the strength of the underwriting. Things can go great and then all of a sudden they can go badly. So we wanted to see how a bad loan worked through the system, and we were happy with it. And that's when we invested as this and we resolved. But the discount still remained. So couldn't prospect like we looked at the other one. Couldn't discount an NAV of 9%. Pre-COVID, it was probably trading, and when we had low interest rates, we averaged a premium of about 4 or 5%. So, that NAV could easily switch to a premium. So you've got, again, that margin of safety versus the valuation of the underlying loans. Strong track record. 7 track year, only one low, 96%, I said 92 if I got that wrong. And then 83% if you exclude the interest payments. Cash is almost fully deployed, so what we don't want, this is why we didn't invest earlier on as well, partly, is because a lot of the companies were getting taken out and the cash was coming back. So we wanted to, you want to pay a dividend and pay investors back, but you've got this cash drag because you've got hundreds of millions sitting on the balance sheet that you haven't lent out yet. So the team have gradually built up a pipeline. So now, as things get taken out, which they are, they're getting taken out probably more so as they were back there, but the loans are getting recycled. So you're getting those fees, and then you're recycling the capital at higher rates as well. And what they've been doing is paying special dividends. So whenever they get, a loan, they get the fees from a loan that someone's being taken out with M&A. They get the fees. They pay the standard dividend of 7 cents. The current share price is about 88 cents. So the yield is close to 8% on this. And then they pay special dividends, and they've just announced one this morning. So quarterly dividend this morning is 0.175, and they've paid a dividend of 0.2. So an extra quarterly dividend has been announced this morning. So we like this profile now where there's no cash drag and there's a strong pipeline in the background. Low equity values increases the demand for these type of loans because people aren't going to issue equity when the equity is so low. So you've got low equity, you've got a discount, you've got limited or no cash drag, you've got a strong track record, you've got an increase in special dividends recently, and we bought in this year, the discount was maybe slightly higher when we bought in. So this is the type of investment that we want. We're strong on the valuation, we're patient, we watch. We're looking for these small niche opportunities. The big, huge funds and the big guys just don't touch, don't understand. And we just dig deep and we find them and we put them in the portfolio. So hopefully that gives you a little bit of colour. Property infrastructure, big broad descriptions, but this gives you a bit more colour on the detail and where we're looking. We're looking kind of under the rug at all these undiscovered gems is what we're trying to find. And that's it. Unless anyone's got any questions. Sorry, we'll race through a lot of detail in a small amount of time there.
Gary or Rich, do you have any sense, given the excellent news this morning on cost disclosure, how much potential capital could flow back into the investment trust market, maybe the percentage of overall market cap?
Sure. I mean, it's not going to happen overnight because, to be clear, the harm that's been sort of built up over the last couple of years is significant. A lot of people have lost, have walked away from the sector, but that will change. I mean, there hasn't been any IPOs, so I mean we're talking billions will return, but it's going to take a bit of time. And also with the changes to the pension market that the Labour government are talking about, trying to encourage more investment in this area, then there should be more allocations from pension funds to the UK and supporting this space. So that secular headwinds that we've been facing will become a tailwind, but it's going to take a bit of time. But that is our opportunity because we can position ahead of that.
Okay, so next up is another one of our curate managers. So this is value now. That was quality, this is value. So it's Lyrical Asset Management, which is a New York-based boutique that was founded in 2008. which probably might not have been the best of time to start a value boutique, and given what the market was doing. We have a very unique style of value. So it's the cheapest quintile stocks, but companies with earnings growth that is growing stronger than the market. Now, at first I thought, how do you find those type of stocks? They don't exist. But that's the corner of the market that Lyrical focus on. And one interesting story is I joined Momentum from a company called Seneca when Momentum bought us. And we did our own US manager search for a value manager, and we came out with Lyrical. We were quite proud of ourselves. We got strong returns from the investment. And that was the US equity strategy. When Momentum bought us, the Momentum team had done the same analysis and come out with Lyrical as their US value manager as well. So 2 separate teams at the time, weren't communicating, both following their research process, and both came out with the same manager. So clearly we hope that Lyrical are doing something right. So I'll hand you over to David now for the presentation.
Thank you. Thanks, Gary. Thanks, everyone, for showing up and being here. I assume I'm after lunch, right? So everyone is, how are you? Good to see you. Good. So anyone here has heard of Lyrical? Oh, wow. Good. Excellent. Oh, good. I hope a good eye. Good. So we are, as Gary correctly described, a value investment boutique. And what I'm about to tell you is very brief. I'm only going to have about 10 slides up there, and 2 of the slides are identical. So pay attention, and you'll get extra points if you see what the identical slide is. But you feel free to ask questions at the end. I'll focus a little bit about what we do and go into a few examples so you can see it. So let's see here. We are a firm founded by Andrew Wellington and Jeff Keswin in 2008. We manage $7.7 billion. It's mostly in our US value product, but I'll focus today on our global value product, which is an extension of it with the exact same process. And that's also the product that will be on the Curate, or already is on the Curate single manager platform. We're characterized by a very high active share. We have 50 stocks chosen from the 2,500 largest stocks in the developed markets, and we have a very low turnover. We turn over about 15% of our stocks annually. Okay, these are not the more important slides. I'll run through them quickly. This is the PM team: Andrew Wellington and John Mullins and Dan Kaskowitz. John Mullins will join me, for those of you who are from South Africa, will join me in early November at the Curate launch event. We can go into exactly who they are. Why would you want to be a value investor, and why is it relevant for the 4th industrial revolution? So being a value investor is very, very profitable. There's this narrative out there that value is dead. And that is actually true if you look at the value index. The only problem is that the value index doesn't represent value stocks. That's all very confusing, because how do they have the right to put the name value in their value index name? And they all do it, by the way. S&P 500 value, Russell 1000 value, MSCI value. And none of them are value indices. They're constructed in a way that makes them actually broad indices. So I'm going to spend a little bit of time on that in the beginning. That's critical to understanding what value investing is. So we believe, I think the common understanding of value investing is that it is buying the cheapest stocks in the market, right? That's the basics. Buy the cheapest stocks in the market. Now, the value indices, if you just buy the cheapest stocks in the market, you get this dark blue line since 1974. The reason we use 1974 in this chart is that's when the indices were developed, specifically here the MSCI. So you would outperform by 572 basis points. That's almost 6% per annum, just buying the cheapest 20% of stocks. So how come it is that the MSCI World and the MSCI World Value have such a bad performance compared to the cheapest stocks? And why can the MSCI World Value call itself a value index? So the way that they're constructed, these indexes, is the way that all of them do it is they have to put roughly 50% of the market cap in each growth and value. So again, the dark blue line is 2,500, the cheapest 20% of the 2,500 stocks. The MSCI World consists of 1,400 stocks. And now they have to balance the market cap 50-50. That's part of how they do it, right? But the problem is that a lot of the growth companies have very high market cap, right? NVIDIA, etc., right? So if they have very high market cap, you need to have a lot more stocks in the value index in order to make up for that higher value cap so you can keep an equal balance, right? So it ends up being that MSCI World Value Index, out of the 1,400 stocks in the MSCI World, has almost 1,000 stocks. Now, that's very different than just investing in the very cheapest stocks, right? That's almost 70% of the market. So the MSCI World Value, and this goes for S&P 500 value, it's even worse there because they were talking about US stocks. There's about 85% of the S&P 500 value is in the value index, right? S&P 500, 440 stocks are in the value index. So this very big skew, and that makes the value index a very bad index because it basically is it's the stocks that don't grow, and that's you don't want that, right? So it takes out all the good growers. So for those who say that value is dead, they're 100% right if they're looking at the value index. The problem is the value index is marketing itself as something it's not, which is value. And if you just invest in value stocks, you will have a very superior performance to the MSCI World Index. Okay, that is why we're value investors, and that's why it's still relevant even in the fourth industrial revolution. What do we do, or how do we do it? We believe that the secret to doing this right is to actually combine value and growth. And value is going to be the driver of returns. We just saw that on the previous slide. Just buying the cheapest stocks, you will outperform the market over time by about 572 basis points, right, on average over the last 50 years. But it's also important to consider other aspects in order to improve your chances for investing. So we have 3 criteria for investing: value, quality, and analyzability. Value is the most important. We work with a proprietary screen to screen the market for the cheapest companies based on 5-year forward normalized earnings. Happy to go into it in detail on the side or Q&A afterwards. And then after we've done that, and we end up with around 20% of the cheapest stocks in that index in the global fund, it's 2,500 stocks we look at. So we end up with 500 stocks that look statistically cheap in terms of earnings. We look among those cheap stocks to find the ones that are good quality. Good quality we define as return on invested capital of more than 10%. So that excludes businesses such as airlines or utilities that have very high fixed costs, so therefore very low return on invested capital. So we exclude those indices because we've experienced that they're harder to get right. You know, they have the high fixed costs, very difficult business to get right. And then on our analyzability criteria, we exclude businesses that are hard to analyze, such as banks or big conglomerates or pharmaceuticals or biotech or high tech, where it's very difficult to get the 5-year forward normalized earnings number right because they're such complex businesses and they don't even have full transparency as to their business, right? The CEO of Citibank, he doesn't know what the foreign exchange trading group is going to make in 4 years from now. No clue. It's all over the place. We could buy a business that's, let's say, a private banking business where you have recurring revenues and just based on the assets under management. That's an analyzable business, but not a big bank that trades and has a loan portfolio that's not transparent and things like that. So we skip a lot of businesses, and that is our approach. Here comes the important slide. If there's any slide that you should remember and not fall asleep while I'm speaking, is this slide here. This is the result of our analysis, right? So on the left side of the chart, you have what other value managers will be able to give you. A cheap portfolio. What you see here is the dark blue column is the PE of our portfolio. The lighter blue is the PE of the World Value Index. And I don't know what you call that color. Also blue is the MSCI World PE. And as you can see, we have an extremely cheap portfolio. In this market with the MSCI World at over 18 times, almost 19 times, we're trading at 10.5 times next 12 months earnings. That's a cheap portfolio. Now, you may say you have crap companies. That's why you're able to buy them that cheap, right? And it could be. However, because of our quality and analyzability criteria, you get the right side of the screen, which is the earnings per share growth of our portfolio versus the S&P, in this case, MSCI World and MSCI World Value. And as you can see, we have an almost 9% earnings per share growth, with the overall MSCI World being at 5.4%, and we're more than double that of the World Value at 4.1%. So this is kind of critical. This is the unusual thing that we deliver in this combination between value and growth is we deliver a portfolio to you that is growing faster than the market at half the price of the market. That's what we're bringing to the table, and that's why this is the most important slide for you to remember in terms of what it is that we do. So this combination of value and growth. No one really out there, no one else really does it. There are other people who are just doing straight value, and that's great, and they'll have good returns and outperform the market over time. We saw that on the first slide. But no one else is really combining this value and quality. It's difficult for quality managers to do it because they're not really, don't have the value approach. And it's difficult for value managers to do it because they just like to find cheap stocks and they don't care that much about the quality. We do have this unique combination. It has a little bit to do with the DNA of the firm. Happy to go into details why that is, but this is the background for what we do. Now, if we take a look at the cheapest quintile PE over time, and here I've taken it back for 20 years, and we look at the PE of the market, that will teach us a little bit about what the opportunity is today. So this, again, the PE of the cheapest stock is the blue line here. That's the cheapest quintile, 20% of stocks. The dark blue line is the universal median. So the PE of the median stock, the median PE in the market, okay? Now that's the difference between the two will tell us a little bit about the opportunity, right? If the cheapest stocks are very cheap compared to the market, there's an opportunity to buy the cheapest stock because that likely will narrow because it's mispriced in a sense, right? So if we look back over the last 20 years and we subtract the value line from the market line, you get this shaded area below. And that's really fascinating because here you can see value cycles actually playing out, right? We had in 2003, we were just coming out. There was another peak here before. I'm not showing it here, but the tech bubble, when the tech bubble burst, we came into sort of say a value, you can call them valley, right? During these valleys, value outperforms because the PE of the cheapest stocks sort of approach the PE of the market. The market PE comes down, value PE goes up. Then and during the financial crisis, it blows out again. The cheap stocks become cheaper, and there's a blow up in terms of the spread. So value underperforms here during this cycle, right? And then value outperforms again all the way until early 18, where value started to underperform. And it underperformed till about April of 2020. And these are called value cycles. So as you can see here, we're right in the beginning of a value upcycle, where that peak is sort of coming down from these very high levels, or this spread peak between the PE of the market and the value stocks coming down from this very high level. That is the opportunity that we are presented with today. That's why it's probably one of the best opportunities in our lifetime, certainly in the last 20 years, to invest in value stocks, in our opinion. Now, within the value space, we actually happen to find, and this is what's related to the fourth industrial revolution, we actually happen to find stocks that are AI related. They're just not the ones that are screaming out that they're AI related, like NVIDIA, for example. But we do find stocks that are related to AI in here, and I can give you some of the examples. For example, NRG. NRG is an unregulated utility in Texas, and they both own power plants, and they also market to retail, power, electricity. And we believe that they will do extremely well as the AI data centers are built out in Texas, and they will benefit from the higher cost of higher prices of electricity in that area. They're vertically integrated, so they own both the power plant and they also do the retail marketing of their electricity, and they can also buy electricity from some of the alternative resources and sell to their clients. So Energy is sort of a company that's a perfect value opportunity, trading at 10 times earnings. It's actually at 11 times earnings today. We bought it in 2020 at 7.5 times earnings. And it didn't move for 3 years until a year ago. And it's doubled in price since a year ago. And it's today just at 11 times earnings. And it's growing faster than the market. And so here's a stock that's growing faster than the market, only at 11 times earnings. And it actually has embedded in it some benefits where it could benefit from the transition to AI and the growth of data centers. Another example in there is Samsung. Samsung, they are a memory chip supplier. They're obviously with the AI, it's going to require a lot of memory through the supply chain, and they are the leader. They have 40% of the DRAM and solid state drive market. So Samsung is obviously also going to benefit from that rollout into faster chips and processing. And then Another example is, well, as I said, WCC, it stands for Wesco. Wesco is an electrical product distributor. So it kind of brings together the NRG that is building out data centers together with Samsung that's supplying chips. What they do is they spend $22 billion a year on various stuff within the electrical space, call it like that. And they have 150,000 customers that they sell that to, making a 20% ROIC on that business. And they're also trading fairly cheap at Wesco, and we believe they've been overlooked, mainly because they have a little bit of buildup of inventory, but also just because of bad communications. And so there's also a lot of opportunity there. That's some of the examples that you see here. What I'd like to do also is just give you a few examples of things that we have held, still hold, some that we've sold that have benefited from AI. And these things were sort of embedded inside the company. No one else saw it. A few other people saw it, and we benefited. One that we sold earlier this year is Broadcom. It has the ticker AVGO, Avago. It has to do with a merger. They merged with Avago. Broadcom is a business that we bought in 2013, so we held it for 10 years. Right? When we bought it in 2013, it was trading at a 13 PE. Right? Now, this chart, just to familiarize you a little bit with the charts that we look at, on the top you have the price of the company. In the middle you have the EPS, the earnings per share growth of the company. And just for comparison, the S&P 500, because this is listed in the US, S&P 500 trades at, has an EPS growth of about 5%. So this stock is growing at 31%. It's growing 6 times the speed of the market. And we were able to buy it in 2013 at 13 times earnings. Broadcom, until 2022, was trading at 14 times earnings, growing at 30% EPS growth, just roughly at the same multiple that it traded at 10 years ago. It kept buying businesses, integrating them. It did extremely well. And then finally, in May of last year, someone realized that 3% of their chip production is within AI, and the price took off. And earlier this year, we sold the company at almost 25 times earnings. It's today trading even higher. We don't believe that it can continue to grow at 30%. We think growth is more going to be in the line of 16%. This is probably where the growth investors come in and look at this business. But this is a business that we recently sold. Here's another business. This is Ameriprise. I mentioned that we don't buy banks. Ameriprise, in a sense, is the only independently listed private bank in the U.S. All other private banks in the U.S. are within the big firms like Morgan Stanley and Goldman Sachs. Ameriprise is sort of moms and pops private banking in the U.S., and it's listed with its own ticker, AMP. So Ameriprise we still hold. It's one of the businesses that we've held since the inception of the fund, almost, I believe, since the inception of the fund. And as you can see here, again, we have price on the top, earnings per share growth in the middle, and price divided by earnings, PE, here on the bottom. As you can see here, the CAGR, the growth, EPS growth for Ameriprise, great business, growing at 2.5 times the market, at 13 times, right, 13%. And we bought the stock at around 10 times back in the early days. But the stock is still trading at around 12 times, even though it has this phenomenal growth rate. It's starting to get a fair value, but it's not there yet. We still hold the stock. Here we have AerCap. AerCap is an aircraft leasing company. Because it falls within the financial sector, I put here on book value per share instead of earnings per share, just because it's a financial, it's better to look at it as a book value. And you have also here price, and you have price to book here on the bottom. Again, AerCap is a great business. We would never own an airline, but we really want to own the aircraft lessors. It's AerCap and Air Lease. For example, we own both of them. Because if an airline goes bankrupt, the first one to claim anything is AerCap and Air Lease. They take the airplane and move it to someone else and rent it out. It's a great business. And they're still cheap, this business. It's still incredibly cheap business. Compared to, in terms of this is book value compared to S&P. Finally, the most important chart, and I said I would show it 2 times. So when you wrap all this up, what we do at Lyrical is we try to find cheap, good, and simple businesses, and the result is this. They trade at 10 times earnings when the market's at 18, and they grow at almost 9% in terms of earnings per share when the market is at 4 to 5. And that's what we do. It's that simple. I think I probably didn't go over my time, but if anyone has any questions.
Thanks, David. Enjoyed the presentation. You said some of those stocks you've held since the inception of the fund. I'm interested to know what you do as you attract new money to the fund. Do you continue to buy those stocks and therefore dilute the growth of those as they're growing, as they get higher, or do you dilute the position in the fund by buying other stocks?
We do not rebalance when we buy a stock. So that's our approach. What that means is that when we get new money, there's, let's say, 50 stocks in the global portfolio. You give us 50 million tomorrow, we will buy, according to the weighting of the model portfolio. It's not totally equal weight. It's cap scaled, we call it. I can explain it exactly how it's done. It's roughly equal weight portfolio. We will buy, call it roughly 1 million of each. For slightly smaller market caps, we buy less. But we have a model portfolio. The portfolio management team is not even involved. They don't even know 50 million came in. The operations just buy the stocks according to the model portfolio, and we don't rebalance, we don't trim, we don't add. We've actually found that takes away from the performance, trimming and adding. We've done a lot of research. Happy to share that, to go into details, but it actually, interesting enough, it doesn't add value to trade around your positions.
You mentioned that you've got a unique DNA. Can you summarize that in a paragraph?
Yes. So in a paragraph, the value investing world is a very small world, right? Sort of starts with Benjamin Graham in the 1930s, call it. He had some students, right? Warren Buffett was a famous one, and Warren Buffett has done more for value investing than anyone in the, he's sort of the polar opposite of the value index, which has done more worse for the value investing than anyone else. But one of those students of value investing was Sanford Bernstein. Something you may remember, became Alliance Bernstein. Anyway, Sanford Bernstein had a chief of research called Rich Pezina, P-Z-E-N-A, who was there in the 80s, and he was working with a guy called Ron Gottfleisch. So they called them like, they're sort of grandkids of Benjamin Graham, if we should do the family tree. And Ron Gottfleisch went on to manage the value group at Goldman Sachs. Rich Pezina started his own firm with money from a gentleman called Joel Greenblatt. Joel Greenblatt wrote the little book that beats the market. It's a little 70-page book. If you haven't read it, you should read it. Joel Greenblatt was all about combining value with quality. He has his own funds today where he tries to optimize each. So it's different than our approach. And he includes like hundreds of stocks. But Joel Greenblatt is very well known for sort of putting that quality criteria around value. The first analyst they hired when Rich Pezina started his company in 1995 with $1 million from Joel Greenblatt was Andrew Wellington, the PM of our firm. Ron Gottfleisch left Goldman Sachs in the end of the 90s in order to start a long-short version of Rich Pezina, inside Rich Pezina, in I think 99 or 2000. And John Mullins and Dan Kaskowitz worked for Ron. That firm was called Elm Ridge. It spun out later, Pezina. So in a sense, Andrew Wellington was the grandson, if you want, and so is John Mullins and Dan Kaskowitz, and those are the three portfolio managers of Lyrical. John and Dan came to us 7-8 years ago because Andrew Wellington had done an interview in a magazine put out by Columbia Business School, a value investing program. And they had been bothering Ron Gottfleisch for many years about focusing on quality and not just value, because it's sort of I don't know if any of you have been an analyst, but if you're an analyst and your PM boss tells you, okay, go analyze, I don't know, Citibank, and you're sitting there and you're looking at Citibank, it's just as cheap as Ameriprise, but for Citibank you get sweaty palms. It's really, you say like, this is never going to end well, no matter what, I'm never going to get this, whatever I say, I won't get it right. But Ameriprise you can get right because it's easier to analyze. So they realized that in their process as analysts under Ron Gottfleisch. Ron is type of personality, he would scream a lot, and I guess. John reached out to Andrew after that interview, and in the process joined Lyrical and brought with him Dan Kaskowitz. So that's how the PM team kind of came together. But Andrew Wellington, is the founder of the firm and the CIO.
Quite a long time ago, there was a Lyrical presentation at a think tank, and I'm pretty sure at that time there was 33 stocks held in equal weight.
That's 100% right.
What changed?
Nothing's changed. You're speaking about the U.S. value product. So our three products, again, the US value product has 33 stocks. Actually, at the moment, it has 32 stocks. That changed. We have one less at the moment, but we're looking for another one. We're a little bit OCD because we like to have 33 equal weighted stock with 3% each and 1% cash. So that's probably what you're referring to. That's the US product. The reason that, so for the US product today, and Momentum's invested also in the US value product, we have two versions of that product, either equal weighted, which we believe is the right way to do things, equal weighted. However, that limits our capacity in the product a little bit because there's the smaller stocks. That as we grow, we become close to 10% of those businesses. So that's why we invented the cap scaling, so that we wouldn't ruin the capacity of that product. And when we started the global value product, we said, okay, we'll just do cap scaling instead of equal weighting, even though ideologically, probably we believe equal weighting is the right way to go. But it's just modified. It's slightly modified equal weighting. For the global value product, there's 50 to 55 stocks. I believe we're closer to 50 at the moment. So it's in a sense the 32 US, not 33, 32 US stocks, and then 27, 28 non-US stocks in it. The balance, if you look at the MSCI World, I believe due to NVIDIA and all these things, I believe the US has a 70% value of the MSCI World today, but we are slightly less skewed there, so we have about 55% allocation to US within those 60 stocks.
I want to echo Gary's comments at the start. How is it possible that exists stocks like yours, cheap and also growing fast, and how is that not arbitraged away?
We ask ourselves that question every single day, right? That's the key. How is this even possible? So there are several reasons for it. Sometimes stocks fall between the chairs, like they may belong. For example, Ameriprise, right? Ameriprise is a private bank in a sense, right? But it's the only type of its kind that's not within a big bank that's separately listed. Other times it's, we've held in the past stocks like, for example, I'm trying to think of good examples. Many of our stocks are really the only one of their kind or one of few of their kind, and they're sometimes not fully understood. They don't fall within their industry exactly right, and that's mainly the reason. It's rare. It happens rarely, right? We don't do more in the U.S. portfolio where we have 32 stocks, 32 stocks. We do 4 to 5 trades per year, right? When we buy, we sell one and we buy one at the same time. So it happens rarely. A lot of our time is spent on screening. So it takes a long time to try and find these stocks. It's not that easy. So that's where a lot of the time is spent. And if you spend a lot of time on screening, then you can find them, but they are rare. They're definitely rare. We couldn't do in our U.S. fund. We couldn't do a product with 50 stocks. Like we have 33 stocks. Maybe we could do 37, 38, maybe 40, but not 50, right? So in our global product, we probably couldn't do a 70 stock portfolio. There's not enough stocks. So remember, there's 2,500 stocks that we look at in the global portfolio. So having just 50, it's a very small part of the universe. So it's very rare. The market is not always efficient, though. It is not. This is a proof. I mean, look at it. I'm saying Broadcom, but just look at some of the other stocks. Just Ameriprise, right? If you have an earnings per share growth of 2.5 times the market, you shouldn't be trading at half the price of the market. It doesn't make any sense, right? A dollar is a dollar is a dollar, right? Yeah, go ahead.
Could you not use AI to find out other stock that you're missing?
Well, in a sense, we're using, well, it's not, AI is a new term, right? But we have a proprietary model, and this may be a good time before Andres asks the question to just describe how we find these stocks. I noticed, but how we find these stocks. So this proprietary model that we work with, which is similar to what Pazina works with, similar to what Elmich worked with, it's similar to what sort of a lot of real value managers work with. The way it works is that we take earnings data for all of the, let's take the US as an example. Well, all the 1,000 largest stocks in the US, for as far back as we can, we pull in earnings data, and then we take analyst estimates 2 years in the future from the street. So if analysts are estimating earnings, then we plot the line, right? So ... Then we draw a best fit statistical line through those dots, take it out to 5 years, so project it out to 5 years. We apply a terminal multiple to that 5-year forward normalized earnings number. Normalized just means we do it with math, obviously, right? But we kind of wing it, right? We draw the line through the dots, we get out to 5 years. Then we apply a terminal multiple to that number. We use the terminal multiple of 9. That's where the multiple of the median stock, the median stock in the universe, the median multiple of the median stock has been most of the time. So that corresponds to a 16.5 multiple of today. So that's 9 times in the future. So it's a shortcut to a DCF. Then we bring that number back to today and we see if the stock price today has more than 35% upside to its fair value, we're interested. Okay, now that just means interested. And we print out this screen. So imagine 75 little lines on a piece of paper times 12 pages, right? You get to 1,000. Is that right? Yeah, you get to 1,000. And we throw out the 10 bottom pages. We just look at the top 2 pages. And then we go over with a ruler and a little highlighter, and we look for stocks that are high quality and analyzable. The way that is in practice done is all of the investment team does this work independently or at the same time. So they go through the screen, they take the ruler, they look down the ruler, they highlight's the wrong word, they skip a lot, right? The first one may be, I don't know, Santander. It's a bank, waste of time, right? The second one may be, I don't know, Fitbit, GameStop. Totally unpredictable. What are the earnings going to be 5 years from now? No one has a clue. Is it going to exist? Maybe, maybe not. Right? So you skip all those, and then you highlight the ones where you're possibly interested. And there may be 7 or 8 highlights on those 2 pages, and everyone does that independently in the team. And then they meet and they decide which one to do an analysis on this week. And that's where the AI stops, because now you have to do actual bottom-up research. And we use all of the expert networks, and we use all of these resources that we have. And that process can take between a month and 6 months, right? And then they come up with a conclusion as to, indeed, this stock is really, truly cheap. Indeed, it is really, truly high quality. And indeed, it is really, truly analyzable. And then it goes on our bench, because we already have 33 or 32 companies in the portfolio that already are cheap, good, and analyzable. So why would this one be better? Which one should it push out? Maybe we have a stock here that only has 20% upside to fair value, but this one has 60% upside. But who knows? Maybe the 20% stock upside to fair value will go there tomorrow, and the 60% upside to fair value will take 10 years, like Broadcom, right? So then comes the art as to when do you make that switch? Do you do a superior substitution, or do you wait for this stock to go to fair value and then you substitute? So that is the process, and then we always have a fair upside to fair value number in the portfolio. We always know what that is. Every day, our models say, today the portfolio has 105% upside to fair value. But we don't always, most of the year, 361 days of the year, we don't do anything. I mean, we do work, but we don't. That was phrased wrong. 361 days out of the year, we do not interact with the market. Then on day 362, we call the broker. We say, "Hi, it's Lyrical. We'd like to do a trade." And they say, "Who the hell are you?" Right? And then finally, they let us do a trade. And then we do a substitution portfolio. That's how it works. And that's not totally true, because we get inflows. We have to act with the market. But that gives you a sense of how it works.
I just wanted to ask, the quality overlay, does that solve for the lumpiness that comes with value, or do you there's no escape?
It's great, really, really great question. So lumpiness in value, do you refer to the lumpiness of price moves, volatility of price, or volatility of earnings?
I think on a portfolio. So when you're speaking to clients and you wait 7 years and it's a drought and all of a sudden value skyrockets, and then so there's a journey to it.
So we managed to outperform our composite, certainly our caps composite. We've managed to outperform the last 3 years by about 90 basis points, which is not what we're looking for, but that beats losing money while we're waiting to make a lot of money, right?
It's 18 years and a CAGR that we're measuring here, so there's a lot that happens in between.
We are long-term investors. That's part of our added value. The fact that most of the market actually is very short-term, that's part of our added value, because they can't see long-term. They're looking for the next quarter, and they all are looking for, well, there's nothing in the next quarter that's going to make this stock go up, therefore I'm not going to buy it. We see, well, here's a great business trading at a cheap price. It's analyzable. Buy it, right? The difference is that we have an undefined time frame, whereas most of the market today has a 1 day time frame, or maybe 3 months, at best 1 year. No one looks beyond 1 year. So the fact that we're playing in that very long term gives us a benefit. the volatility of our earnings are less than that of the market. The drawdown of earnings in recessions is much less than the market. I don't have a slide in this presentation. So our earnings volatility is much less than the market, but we cannot control what the price trades at any one time a day, right? Because the market may say, I hate cheap stocks, right? And I'll just sell all cheap stocks without looking at earnings. That gives us an opportunity to the question in the back as to buy those stocks cheaply, right? But it's, I would say our earnings volatility for sure is less than the market. Yeah, absolutely. And that's what we're aiming at by buying only quality and highly analyzable businesses. But the price volatility is not in our control. So, you decide to vote for Brexit in the UK and, markets fall and the price volatility rises. That has nothing to do with the company, nothing to do with our analysis. It's just for 1 week, So price volatility can sometimes be higher, and the cheap stocks sometimes can be a victim of that. Then you have to look at the earnings. We look for stable earnings. I mean, you look at it here. This is, I don't know what I have, MR price. Look at this stability of earnings. Look at the, I don't know if I have a one up here that's really shows you these stocks have a much better earnings history than the market. That's what we look for. We look for that stability of earnings.
You got to invest and look for what's on the box. So no one's looking for you to a value manager for consistency. It's a long-term play and it's a part of a portfolio. You wouldn't put your entire portfolio in a value strategy.
I have my entire portfolio value
because you just see it.
But you understand. Yes, you shouldn't. Clients should not put all. Look, I'm not going to sugarcoat it, right? Value investing is buying cheap stocks that are, where the market doesn't recognize what they're worth. What we do is we try to take away some of that uncertainty and only buy cheap, high-quality, analyzable stocks, and that mitigates some of the price risk there are. I would always encourage you to look at the underlying earnings of these businesses. So look at earnings per share, look at the stability of earnings, and then price. I mean, if you look at this earnings per share, look at the price. It's much more volatile than the earnings.
Sure.
So you have to look through and look at the earnings per share.
Brilliant. Thank you.
Yeah.
Any questions? Okay. Thanks, David. That was over. David.
That is day 2 done. Thank you for joining us. To recap, we've heard from Evenlode's James Nodler and Christina Dyer about their approach to picking stocks and why it pays to invest in companies that deliver not only high, but persistently high return on invested capital. We call this a quality approach to equity investing, and it is one of the key styles that we think works and that we therefore target. AI is helping to bring down costs and improve the accuracy of Evenlode's own data capture processes. It is also, no surprise, a key enabler for many of the companies they invest in. Ben Wilkinson then spoke about opportunities in venture capital and fast-growing innovative companies. We access these opportunities via an investment vehicle called Molten Ventures. It's listed on the London Stock Exchange. Check it out. One of the companies within Molten Ventures' portfolio is called Form 3, and CEO Mike Walters explained how the company is helping banks and regulated fintechs with an end-to-end managed payment service. It delivers complete payment processing, clearing, and settlement schemes. Yes, sounds incredibly dull. Trust me, when you listen to Mike explain it, it is not. Next up, listed opportunities in real assets from my colleagues Gary and Richard. Perfect. They spent time talking about investment trusts, which are closed pools of capital, a bit like a lock-up fund, but at the same time still liquid because they're traded on the London Stock Exchange just like any other stock. This, in our view, is the best way to invest in real assets. It gives the management team time and control over a fixed pool of capital. It gives you investors access to liquidity should one want it. They spoke about investments in property, in infrastructure, in private equity, like Molten Ventures, also debt, and many of these opportunities look very cheap to us today. Finally then, we had Lyrical's David Merklin. He made the case for value investing. Now, we think a quality approach to picking stocks works. That's what I spoke about earlier in terms of Evenlode. So does a value approach. Get a copy of David's slides because he offered a comprehensive defense of this notion that value investing is dead. Now, finding reasonably good companies at reasonably cheap prices may sound fairly dull, but it produces consistently good returns. Today, we think value stocks look compelling. That's it from me. And then to say, if you'd like to receive continuous professional development, CPD points, please watch the full session and ensure your ID number is logged in. You can revisit this session anytime until the end of November and still earn those points. And finally, we've now automated the sending of CPD certificates. They'll be emailed to you as soon as you've finished watching the full session. Again, thank you for joining us today. We look forward to seeing you virtually tomorrow.